Good morning, everybody. Let's, I'll do announcements and stuff while y'all are filtering in and sitting down. We have new CE procedures. So right now we're not in a CE classroom. You can imagine that. So I'm going to thank all of our sponsors: Bridgewater, Whipfleet, JLL, Collier's Mortgage, Infocus, Minnesota Housing, MHA, Greystone, Northmark. See how fast I can do it. Great Southern Bank, Washington County, Chase, US Bank, and Home Safety Solutions. Thank you for sponsoring this networking breakfast. In a minute, we're going to start our CE portion. So if the first panel wants to make their way up to the table, and I'll talk while we're doing that. I'm Todd Phillips. I am CFO of Real Estate Journals, REJournals. We have 6 publications across 17 states, do about 150 events a year. Jeff asked me to moderate some of the panels today, and I haven't touched a microphone since COVID. So some of you might remember me from your television screen. I moderated over 100 panels from my basement during COVID. And so I took a couple of months off and I'm back today. So today's my first day. So I did like I did in my basement. I got a bunch of Mountain Dew ready to go. I got dressed up from the waist up, just like I would at home. And I showered last night so that I could sleep in as long as possible this morning. That was my routine during COVID. So I'm just going to continue that today. Moving on here. This is us, REJournals. I already said that, but for those of you that aren't familiar, a big part of my job has been going out and acquiring other publications and moving us into new states. So Jeff and I have made a big deal about that. So now we're in Texas. We're in 17 Midwest states. We've got, like I said earlier, 150 events across those 17 states. So look for us not just in Minnesota in the future. Today, multifamily financing, state of the market. I've got a couple CE announcements. So we are going to start the CE portion of today's show. If you are online and doing CE, you have to answer poll questions. If you were doing this in the past, they were in the chat room. Now the questions are poll questions. Jay Cody text back there. He'll pop them up on your screen. You'll see it pop up. You have to answer that within a certain time frame to let us know that you're paying attention. You have to answer 2 questions every hour, and you have to answer all of them. All 8 of them you have to get on time, or we can't give you any credit at all. Not a rule. That's the state rule for online CE. So I appreciate you all doing that. Live, all you have to do is sign in and sign out. So if you forgot to sign in, go do that really quick. And don't forget to sign out on your way out, because your signature on the way in and your signature on the way out, we also can't give you CE credit. Thank you for that. Moving on, I'm going to let the panelists, I'll kind of introduce them, but I want them to do a deeper dive into their introduction so they can tell you more about their role at their company and what they're doing and what they're working on. Our first panel, we're going to talk just broadly about multifamily finance, but on the banking side mostly, and on the new development side, and then some of the effects of the current economy and some of the other things that are going on. So I'm going to start let's start with John. If you want to do a brief introduction of what's going on at Bridgewater and what you do there. Sure. Let's get your microphone. It has a mute button on it, and you'll have to turn that on. It's on the middle right there. Everybody's got one, so y'all can activate your mics if you want.
Cool. John Tollefson with Bridgewater Bank. Little background on Bridgewater and then myself. Bridgewater's roughly a $3.5 billion bank. Been around, started by Jerry Bach and Jeff Schellberg and MJ Crocker back 16, 17 years ago. It's publicly traded on the NASDAQ. At this point, legal lending limit north of 40 million. Primarily grew based on our appetite for commercial real estate, and multifamily being a huge component of that. It's our largest concentration of commercial real estate, roughly 35% of the loan portfolio. Currently, we have about 3,500 apartment units financed under construction, and that's about it for the background.
That'll be wonderful. Let's keep moving down the line, John. Let us know what's going on at Wells Fargo.
Morning, everyone.
Oh, I'm sorry, I skipped over.
That's fine.
Carl, sorry.
Go ahead, Carl.
All right.
You all don't look exactly like your
Sure.
pictures. You look,
Perfect.
you look.
Carl Brandt, managing director at Great Southern Bank. So I manage our Minneapolis and Iowa markets. We're about a $5.6 billion bank. I'd say kind of a regional. Our footprint kind of runs Minneapolis to Dallas, and we've got loan production offices in Chicago, Atlanta, and Denver as well. We're a heavy real estate lender. Most of our offices are very active in multifamily and other product type development. Really kind of focus on ground up construction and a lot of reposition of assets, like I said, across all property types.
Well, thanks, Carl. Now you know that I got used to doing Zoom where everybody's name was underneath their little picture. So it's easy to call on people. Patty, Gnetz, what's going on at US Bank?
Good morning, everyone. And thanks for all that are watching on the video. Todd wanted me to do a shout out, so a shout out to everybody on the virtual today. I'm Patty Gnetz from US Bank. I'm in the commercial real estate finance area of US Bank. We finance commercial real estate throughout US Bank in a variety of areas relating to a variety of the different sizes and types and needs in the commercial real estate industry. My area, again, is focused on commercial real estate companies that where commercial real estate is their business every day. We have 25 plus commercial real estate offices throughout the country. We follow our clients from the based area throughout the country. So I have financing throughout the national footprint. We focus on lines of credit, construction loans, term loans, non-recourse term loans, subscription lines, a variety of financial products that fit our commercial real estate clients.
If you see me, I'm geeking out up here, so I keep looking down. But for the people online, I have the chat room up here too. So if you have questions, if you can't hear, let us know through the chat room or anything else. I'm monitoring that up here as well. Let's move on down to Joel.
Good morning, Joel Torborg with CBRE. I'm the only non-banker up here, a mortgage banker, managing director at the local office of CBRE. We kind of do full array of product types along with lending sources. We're a Fannie Mae, DUS, Freddie Mac, Optigo lender, HUD, banks, life companies, debt funds, other. So kind of, again, jack of all trades, but I think I'm here to keep these guys in line and then bring a perspective of, outside how we represent clients as they're looking at bank options. A lot of times that's looking for non-recourse options. It might be borrowers coming in from other markets, vice versa, borrowers from this market going into other markets. Any given year, 25 to 40% of our business in our local office is done outside of the state of Minnesota. And so kind of figuring out what the best lending source is to match the business plan for the borrower.
Last but not least, John, sorry. Tried to get to you earlier, but.
Appreciate it. Good morning, everyone. John Rent with Wells Fargo's Commercial Real Estate Group. I sit in our office in Minneapolis here. We cover clients based in the upper Midwest, follow them throughout the country where they go. Really offering construction loans. I'm on the balance sheet side in particular. So construction loans, term loans, and the full gamut of balance sheet options. Of course, our platform overall includes agency financing, at subscription lines, product specific specialists and whatnot. So we're a full service real estate platform, but I focus on lending on our balance sheet.
All right, well, let's have some fun, right? Real estate finance, fun. Those are in the same ballpark, Joe.
Right.
Okay, well, we're going to try to make it as entertaining as possible this morning to keep everybody's attention. But let's start out just talking. What I'd like to do for everybody in the room and everybody on the panel is sort of a boardroom style discussion. So if you have something that you want to hear about or you want to build on a point, feel free to raise your hand. And likewise, if you're online and you have a question, bring it up. And these people would love to get some interaction with the audience and each other. So I'm going to throw a couple of things out as questions that you can just grab and answer. Let's talk generally. Apartment market in Minneapolis. I would have said, I'll go out on a limb, and 2 years ago, I would have said it's frothy and maybe we're overbuilding. And we could use a little recession to maybe rein some things in a little bit. And then we got a recession, but it didn't turn out not to really be a recession. And everybody seems to be back with their foot on the gas. What's the current state of the market? How are you all looking at the new construction, the new things coming online today?
I can jump on that first. I think when we started COVID, we really didn't know what to expect in the multifamily space in particular. But in the product that, that we finance, oftentimes new construction, new product, we've been very pleasantly surprised at how rent collections have held up throughout COVID. At this point, they're either the same as normal in the high 90s or maybe just 1% or 2% below. And to your point about kind of pre-COVID, what we thought might happen, I agree that it seemed like the market was frothy. And if I had to guess what was going to happen in a recession, it was going to be an overbuilding of downtown apartments or Class A apartments that would have seen the weakness. But at least for rent collections, those were the ones that held up the best because the white collar workers living in those units were the ones that kept getting paychecks throughout COVID. And all of a sudden we're spending all their time in their units. But that said, I think that, at least in downtown Minneapolis, there has been a lot of units delivered, lots of the amenities and reasons you live downtown to be able to walk to the office and walk to restaurants and walk to sporting events have been depressed for a while. So there is a fair amount of weakness there. Conversely, in the suburbs, I think those are as strong as ever and continue to see a lot of momentum there.
I agree with John. I think the apartment market still remains quite strong. The downtown areas, of course, are experiencing a lot of stress for the reasons why people would live downtown, because we're all not back to work yet. And so that's still to come. I think that there are many of us, including myself, that are very pro downtown Minneapolis and pro downtown St. Paul. But it's still, you got to get the workers down there because that brings the energy, that brings the restaurants and the concerts and the theaters. And so when that comes back, I really think there will be a vibrant area, and those apartments, that multifamily product will work. We see a lot of product coming into still new projects in the suburbs, and the leasing the absorption is still strong, quite strong. And I'm sure others will talk about it later, but we're also seeing a lot of institutional interest in purchasing those apartments once they are leased and stabilized. So I think it's a very strong market.
So lease up downtown Minneapolis versus suburban, because I've heard rumors that downtown Minneapolis, they're signing leases at a really high clip over the last 45 days. Is anybody hearing the same, or is it just a lot of the activity in the suburbs right now?
No, I've heard or seen numbers. You also have to take that in context of what happened early on in the pandemic, where we saw multiple projects that were mid to upper 90% occupancy that dropped into the mid 70s. And that wasn't unique to those projects. That was kind of a lot. Now we've heard upper 80s approaching 90s. So yes, there has been a lot of velocity to get there, but it's in context of the drop that happened. But I think if you look macro overall and why the multifamily market has performed, continues to perform, and we believe it's going to perform well in the future, is just the lack of housing in general. And we talked on the prep call about this is in context with both single family and multifamily, and looking, that I've seen reports out there that we're 5 million units short of where we need to be, and population continues to grow. So trying to catch up to that, delivering an affordable single family home in a location that people want, it's becoming more and more, or I guess less and less affordable for first-time home buyers. So some people who may want to own a home, I'm sure everybody in this room has heard a story of somebody who's been out looking, trying to buy that first home, and just has given up because they put in multiple offers, keep getting outbid, or not wanting to make an offer that has no contingency in it, no financing, no inspection contingency, and just unwilling to do that. So we foresee the.
Sorry,
echo, or?
I'm hand signaling, try to get rid of the echo.
Okay.
I was trying not to interrupt you.
Maybe I
You're on
don't
a
need to
roll. Keep
lean
going.
in as much as I did. So we'll turn it to the side. Do I sound like I'm in a canyon still? Better?
A little bit, we get a little bit of bounce off the walls, but then if we don't bounce off, I also happen to be the AV guy at REJournals. Then I get complaints that they can't hear. So
Okay.
you get what you get.
Trying to recall where I was at.
Told you we'd make it fun.
So I think we're just talking about the affordability for single family homes and how that is acting as a continued demand on the multifamily side. And we foresee that going, if you look locally, generically, 80% of the people live in the suburbs, 20% in the urban area. And in our last development cycle, it was probably flip that 80% of the new projects was in the urban area, 20% were in the suburbs. And now you're starting to see that suburb development pick up, and that's why the demand is there, and that's why you're seeing the good lease up velocity that you're seeing in the suburbs.
So John at Bridgewater and Carl at Great Southern, what are you all seeing similar? Are you lending a lot in the suburbs and seeing some activity there that is encouraging?
Yeah, definitely. I think a lot of first ring suburb and infill development within the city of Minneapolis as well. So kind of these, some of the smaller buildings, definitely under 100 units with nice infill sites. Those are smaller projects, but with a limited number of units, the lease up is quicker. And those are pretty easy deals to actually underwrite. Less amenities, so you're not really pushing the higher rent levels at this point. So, but yeah, I would definitely say when I kind of look back at just the overall cycle, when you kind of look back 20 years ago, I think for the apartment market, we didn't really build apartments in this market for probably a good 10 years early in the decade. So we're just, I think at some level, just catching up to really what we should have been building, 15, 20 years ago.
It's interesting. You can visibly see a gap in architecture styles in our apartment market. It's interesting.
And I would echo what Carl says based on size of banks that Carl and mine are relative to Wells and US. 125 unit infill or less projects have been exceptionally strong. Did not see much in concessions. And they're back to full rents, and leasing is very strong. We remain super bullish on the multifamily market in the Twin Cities in general. And
Go ahead, babe.
And picking up on these comments here, the single family market is definitely affecting the multifamily market because you can rent an apartment and it's move-in ready. Everything's nice. You have everything new. You have a certain amount of amenities, smaller or larger amenities, whereas you can find a house to buy, but it needs major remodeling. So then you have to hire the contractor, and then a lot of the product isn't available right now because there's a slowness of the product. You have to find someone to do the work. You have to find appliances. So it's just easier to rent an apartment. So it's still very strong for a lot of the population.
Yeah, put in a plug for our land conference. If you were here 2 weeks ago, we had two of the larger home builders up on this panel, and they both said they're not doing starter homes. And there probably is no such thing as a starter home right now, because if there is, it's $350,000, and that doesn't meet the income of somebody who wants to buy a starter home. Some more constraints on the market. Well, I played nice so far. We threw out the softball questions, but being a lender in multifamily hasn't necessarily been easy over the last 18 months, right? We've had commodity prices bouncing all over. Lead times go out several months where it should have been several weeks, and all kinds of hiccups along the way. So how have you dealt with some of those hiccups, and what's the latest update on current construction draws or projects that are under construction?
We haven't experienced a lot of issues. I would have thought that, you would have run across projects that were under massive delays or had some other issues like that. We definitely have had, some projects where people have decided to push this into next year, hoping that commodity prices have come down, and to some degree they have from where they were this summer. But I think most had a developer that was working on a project. There was some electrical part that they needed to get. They basically sent as many people as they could, just driving around every Home Depot in the metro market to find, the product rather than trying to source it somewhere else. So, getting, they're getting creative on how to get there. Some developers I've talked with, rather than, the same refrigerator in 100 units, I'm going to buy, I got to get 100 refrigerators, but they're going to be 5 different styles. And at some point in their mind, they decide that, in 5-10 years, I'm going to be replacing these anyway, and they're not all going to be the same. So what difference does it make today? So I got to get my project done. So we've seen people get creative to get projects completed at this point. Definitely have had a few, budgets that have gotten busted. And, one of the recent ones, we're trying to close a deal next week. A budget got busted a little bit. And we actually went back, re-underwrote the deal. With the pro forma rents we underwrote originally were pretty conservative. And we kind of took a second look at the market and decided that the market was stronger. And so combination of developer put in their share of cash, and we're increasing our loan to cover, and we're going to make the deal work and get it closed next week.
Wow.
I'd echo that same feeling, Carl, that you said about, almost expecting there to be some sort of budget issue before a loan closing. Well, hey, the GC finally bid out the project based on final design drawings, and hey, it turns out here's this delta that we've run into. That's since lumber prices started running up, that's just been something, and really all commodity prices, it's just something we've expected. And we kind of go through the same exercise is, well, the offset in this kind of inflationary commodity market is in lots of markets across the metro here and across the whole country, rents have been increasing as well. So we can take another look at our underwriting from, maybe when we put together our first run at it several months ago, and get comfortable with a little bit higher underwritten NOI, and that would justify lending into a bit of that cost increase. But that's just the name of the game right now, and really the first time in recent decades that we've really worried about those commodity prices. So we're really paying attention now to buyout requirements in general contracts, where that was always something we keep an eye on, but now we're asking some probing questions about that. Are you under contract with your lumber? Are you locked in on your concrete? Are you locked in on your steel? Because there's real risks there that we just want to understand. But for the most part, at least lumber has come back down. I mean, it's after a huge run up, it's down, not quite to normal. But, I think in the coming months, we'll really see that stabilize. I think right now we're working through supply sitting in lumber yards or coming over on boats that still have a higher price tag attached to that particular lumber, and that's got to work its way through. But in terms of spot prices on the market today, they've more or less normalized.
When you say normalized, do you mean come back down to earth, or do you mean they've just stopped going astronomically?
They've come back down to earth, maybe
Okay.
not fully, but no, it's not just that they've stopped rising. They've definitely come back down.
That's encouraging.
And I will say, I talked to a couple of clients recently, and, basically not expecting costs are the costs. They're not going to come back down. You might as well plan thoughtfully, and it'll work.
In the underwriting, we're watching very closely again with the cost and how much has been bid out by the time you close, so that they have certainty of execution and certainty of price. Also, we're making sure that the contingency levels within the budgets are robust enough, because in years past, everything was kind of fine if it was a 2 to 3% contingency, and now it really needs to be a 3 to 5% contingency, because they will use those funds. We're finding some strange things. It isn't all lumber, which has come down. It's at the same price as September of last year. So it really is down considerably from when it spiked in May of this year. But we're finding we're in a third phase of an apartment, multifamily, 300 plus units, and they can't get carpet pad. And it's because of Texas, and it's because of the weather in Texas that the factories aren't making the foam for the carpet pad. So, we blame a lot on China, and we blame a lot on our ports and things like that. This one is foam, carpet foam in Texas. Also, we found we're in the middle of another project, a large project that is going to deliver next spring. And the almighty chip from China for the smoke detectors, they can't get it. And so they had to go out and, as you said, they punt and they found a different smoke detector that can be delivered in a massive amount. And so they changed what it was. They like it better, but it's just, there's a lot of little things in addition to appliances and what have you. I guess I was kind of shocked about the carpet pad, but that was a new one for me. So we're seeing a lot of that. And then just the delivery time, it takes longer. So I think when bidding out with GC, it isn't always the GC that's going to finish your project the quickest, because there will be delays. So, you know, just to be aware of making sure it's a normal amount of time and it allows for some delays, because it will happen with COVID. You know, you have 10 people that can't show up or what have you. It's just normal. It's our new normal. So.
Well, you segued there for a second and then you came back around to commodities. So I think we finished up on commodities. That's great input. I'm glad to hear a lot of those things, but you started to touch on underwriting constraints. I think you're just talking about cost overruns, but what are the constraints right now that are giving you headaches on underwriting, that's keeping maybe a deal on the verge of getting financed from getting financed? Is it loan to value? Is it cap rates? Is it exit cap? Is it rents? Is it cash flow? What things are kind of keeping you up at night on the underwriting side, on the new construction? Don't everybody talk at once.
Well, I think we talked in our prep call a little bit about loan to values. You know, I think in this cycle with aggressive cap rates, loan to value just doesn't really come into play as much as it used to. Yeah, I think you know, from a industry standpoint, yeah, I think we're obviously much more focused, I think, in this cycle after kind of learning after the Great Recession of, you know, cash is what repays loans. And so cash flow is king. So I think everybody really focuses hard on what the NOI number is, what's that cash flow look like, kind of translates into a debt yield. And that's typically, you know, what I see in this cycle has been the probably the most limiting factor in terms of what your underwriting is. It is interesting, you know, and I kind of look at different markets that we're in, you know, the availability of capital to come in, and we see, especially in some markets where the equity number comes in at 35 or 40% equity because they're looking for minimal recourse on the debt. So, you know, maybe in this market, I think we have probably a little bit more propensity to sign guarantees, and so a little less equity. But it's interesting to kind of just see across, you know, what different markets look like. And obviously more equity that comes in just makes your underwriting a lot easier.
So you said a word that I'm not familiar with, debt yield, was it? I put that in the poll question for those people who are online. For the people live, I think it said something like, yes, I knew how to calculate it before today. And or the other answer was, what kind of Greek are you talking about? Or, you know, so maybe you can give us an explanation for those people in the room who aren't familiar. What is that constraint and how does that operate to?
Well, debt yield, I mean, it kind of came out of probably more CMBS type of lending, but that's a measure that we look at. You know, I think apartments, most banks are looking at probably more like a 8 debt yield is kind of the minimum number. Every property type.
What does that mean? How do I calculate? You don't have to do the math, but just generally, what does that mean?
The calculation is it's NOI, NOI divided by the loan amount. So you're trying to kind of calculate what a return looks like. Every property type's got a little bit different debt yield on it, but I'd say most multifamily lenders probably start at an 8 and then kind of go from there, see where it goes.
So would that be like a built to cap rate? Is that how a developer might see it?
I'm not really sure how a developer would necessarily look at it, but
Joel, no.
I think the easiest explanation for what a debt yield is, I think most people know what a cap rate is. Instead of using the purchase price, you're using the loan amount, just dividing the NOI by the loan amount.
There you go.
And it's, you know, it may be a two-step way of as cap rates continue to compress and become lower and lower, and groups are trying to be conservative and say, we think they might increase instead of applying a cap rate and LTV. You could kind of do that in one fell swoop with a debt yield.
So knowing what your NOI is, by reducing the debt amount, that will increase your debt yield.
Correct.
So you may be reducing somebody's loan amount until you get to the debt yield that you're targeting, which you said 8. Maybe if you're trying to get aggressive on a deal, or a deal makes sense for other reasons, you might come down from that. Are there any other underwriting constraints that are giving you headaches right now, or your clients headaches?
I really think the rev limiter is debt service coverage. Yeah, NOI. I think expenses are not contracting. I don't see a lot of room for expense and reductions going forward in the multifamily world. So what you have is rent growth, and to support, and if you're driving loan dollars, we'll still look at 80% of cost financing. It doesn't work on the larger deals per se, but an infill project that's well managed with a strong sponsor can get there. The debt service coverage ratios just get so tight at higher loan to cost. So that's the trick.
Yeah, I'd maybe agree on the debt yield piece and debt service coverage. If at a minimum interest rate is an implied debt yield as well, and also agree on the factors that stress that right now. It's project costs are going up for all the reasons we talked about before. Both long-term commodity price increases, labor price increases, as well as some of the short-term issues. And is rent inflation meeting that, as the months and years pass, and expenses are just continuing to accelerate faster than rent growth in most markets, especially real estate taxes, which are really tough to underwrite and try to figure out what that's going to be, especially on a prospective basis. Especially think about how an appraiser might look at real estate taxes. So, that's those factors of stressing NOI, preventing it from growing as fast as project costs do, is what pressures that debt yield sizing constraint on a loan.
Well, let's pivot a little bit and talk about your takeout. So if you aren't doing a Mini-Perm or some kind of a perm solution, are you looking down the table at Joel and saying, how are you going to get me out of this thing? Knowing that our next panel is HUD and Fannie and Freddie, and they're going to talk a lot about that. But there are, issues with they may be pushed to doing more affordable in those markets, and could cause some consternation for you all. So how are you all looking at takeouts right now? Or cap rates good on the exit? Or do you feel like there's adequate capital out there chasing deals once they're stabilized?
We've experienced that there's adequate capital in the marketplace. The mortgage brokers have a plethora of lenders that will finance multifamily, and multifamily is very hot. Industrial is hot. And we see that, at least in our portfolio, most of the takeout has been done with life cos. If not, most of them are sales. So a lot of our clients are selling the product once stabilized. So it isn't that our client is doing a lot of refinancing. We also offer a non-recourse takeout. So we could do some of that, but I would say in the past 6 months to a year, most of the product has been sold.
Yeah, I think when we talk about other lending sources besides banks, there is really good liquidity. Even though the agencies have their caps lowered a little bit, they're still monitoring that well. But the other sources, life companies, are really record allocations. One group that we really saw step up also are debt funds. And basically, the project doesn't need to get fully stabilized. At the debt funds, you really can take it out almost any time after CO. And the going in debt yields that they're looking at on some of these deals are minuscule, and looking really, they'll go 75 or 80% of value and look at the year 3 NOI. And if that's at a 6 debt yield, that's really sufficient for them to really lend on that. So they're getting really aggressive on that front. Life companies really still like the multifamily market. It's the biggest percentage of their allocations that they're lending, and they'll project forward. So they don't need to have the actual income in place. agencies do have some pre-stabilized product for the most part. They're looking to have the income in place and looking at a trailing 3 months. So there's just really a lot of liquidity in the market, both on the equity side and on the debt side. So there are many options to take those deals out.
Okay, I don't want to glaze over that. I'm a novice at this, Joel, but what you said just blew my mind. You said CO and not stabilized, and aggressive debt yield, and on and on. What? Give us some ideas. It sounds like you can finance anything. Why would I wait? Why would I wait for a Fannie Freddie takeout? Why would I wait for stabilization anymore?
Well,
We don't even need panel 2. Y'all can just
yeah,
go
and
home.
again, it depends on the business plan, the risk appetite of the borrower. It may be a group that is acquiring an asset and they think by taking it on some lease-up risk, they can get a better basis in it than waiting for it to be fully stabilized. And it might not be that they have a 10-year hold plan. It might be, we'll take this on. We think we can, through the lease-up, through operating it, we're going to increase the revenue on it. And in 2 or 3 years, we're going to sell this. So it's not a long-term hold, where it may be a family office, something like that, that is maybe a generational hold, and they want to lock into it. They like to use leverage. They're probably not going to be looking at taking out earlier in the process. They might wait for it to be stabilized and lock into it. Institutional groups, again, might be in between that, where they want to lock it up for a long period of time, take some risk off the table, but they'll put a lot of equity into it, want full-term IO. And so they might look at closing when it's 50-60% occupied, but not right after CO. And so the life companies, how they're underwriting it, they're projecting what it's going to look like when it's stabilized, but they might just look at less leverage than they might if it was a fully stabilized deal and there aren't as many questions as when it's leased up. So I think it's really you have to sit down, listen to the sponsor, to the borrower, what their goals are, and discuss what their how each particular debt is going to function on their business plan, so they understand that they're not locking into a 10-year deal if their plan is to sell it in 3 years, so that they have the flexibility. And nationally, we're seeing still a lot of the institutions like floating rate options, just for the liquidity event that they may be planning or may be unexpected, but they don't want to be stuck with the debt being the tail that's wagging the dog and not allowing them to sell an asset and liquidate it. And whether it might be a geographical change in their plans, where this was a market that they liked, now it's something they want to get out of, but they want that flexibility. So again, it's just there's so much liquidity at every level, every term, to match what the business plan or the investment plan is for the borrower.
I totally agree with what Joel said, and there's just so much capital out there. And again, when you pay attention to the owner's investment strategy and their goals, the prepayment penalty might come into play quite a bit, because through all of the lending options and the debt options he talked about, there'll be a variety of prepayments, so that some want flexibility, some don't need flexibility. So I think that in addition to the loan to value, loan to cost, that all makes a very big difference for the various financing types.
I just wanted to touch on something, Patty, you brought up, and then Joel, you touched on it again, about the kind of maybe emerging trends of people buying or looking to finance projects right after C of O, before stabilization. I think maybe what you were referencing, before, is you'd wait for stabilization, then put on your agency debt, and you're off to the races, right?
I feel like I should learn to drive a backhoe and just go break ground somewhere. You could get it financed.
I think what I've heard from some folks of what's driving that really is just cap rate compression, that some of the Class B product out there that's for sale is so expensive that for the same dollar of NOI, you can buy a brand new project that just got C of O compared to one built in the 1980s or something like that. So if that's the case, if that's the pricing that the market's giving you, why wouldn't you take a little bit of lease up risk, especially if the market data shows you're going to be able to lease it up pretty quickly and, get a interim loan from a bank or a debt fund, and take that lease up risk and then put on your agency financing. So, and the liquidity's there, and, the liquidity is also causing that pricing, right? It's driven the cap rates on 1990s and 1980s vintage apartments to the same level as, virtually the same level as brand new product.
So they can use the debt fund as bridge potentially too, as an in-between product. I don't know why you would. I don't understand that, but what do you give up? I'm sorry for going on with this, but I hope you're getting good information on this. What do you give up by financing at C of O? Is it proceeds? Is it rate? Is it, what is it that there's got to be something you're giving up, right? As borrower?
Well, I think a lot of people in this market will, I don't know, I'll call it, they'd rather climb into bed with the devil they know than the devil they don't know. And having a relationship that you trust, that when an unknown comes up in the process, they're going to be there to step in. You trust them, where debt funds, accurate or not, might be perceived as not as nimble. You're not going to have somebody there who's is reasonable and understands and looks at it as a true relationship. That yes, we're giving something on this particular deal. We might not be getting anything back, but what we're getting back is future business from this client. I mean, it is more expensive, although pricing is extremely, we've seen 80% in the extreme low threes. There's a higher origination fee than there would be with banks. The attorney's fees are going to be much more. Just the overall closing costs are going to be more. You probably have a longer lockout for prepayment, 15, 18 months. We've negotiated down to 12 months. A lot of times the business plan is in excess of that. So there are things that you give up. I think a lot of it is perception on what you don't know that's going to come along and how you adjust to that. That a bank would be more nimble than a debt fund might be in it. But nationally, non-recourse is king in a lot of markets, where I think we've got the Midwest values here, where I'm going to repay it anyway. So a lot of groups will say, I'm not going to pay a penny more for a non-recourse loan than I will for a recourse loan, because I plan on paying it back. But that's not the same sentiment around the country, where recourse is not an option. It's got to be a non-recourse option. So there are reasons. Also, depends on your cost of capital. Some groups, the equity is really expensive. Some of it is inexpensive. So you have to look at the delta on what non-recourse from a bank would look like versus what non-recourse from a debt fund looks like, and kind of try and spell out what those additional funds cost of capital is.
Maybe just one other point on that is there's probably still a bank involved in that debt fund deal, right? That's the secret, right? Including a line of business within our Wells Fargo's commercial real estate platform banks the debt funds. So, they're making you a 80% loan to cost loan. Well, Wells Fargo has taken 65% of that loan on a repo facility as collateral to lend to the debt fund, so, and that debt fund can't do anything unless their lender lets them. So it's not just you and the debt fund across the table. That relationship is probably tougher anyways. It's probably not as relationship based as it would be with some other capital provider, but there's also someone else at the table that you may not even see.
Yeah, I think if you look at what the debt funds are providing, they're providing a one-stop shop for borrowers and really manufacturing, whether you want to call it an A/B note or an A note with a mezzanine loan behind it, that's seamless to the borrower. So they only have to go to one lender. There's no intercreditor agreement. And like John said, they're leveraging it some way, shape, or form. They're hanging on to the riskier portion, either selling it individually to a bank using a repo line, putting it into a collateralized loan obligation where they sell bonds on the backside. They're leveraging it for the most part in some way, shape, or form to get to that aggressive portion of it. And by hanging on to the most risky portion of it, their returns, might be in the upper single digits as opposed to the low threes that we're seeing on the debt overall.
It's humbling, just like I just got a little PTSD from Zoom when you look down at your computer and you realize how much your forehead's grown over the past. I've got that going on up here as I look at my computer. It gets bigger. Why is it getting bigger on Zoom? It really doesn't look like that. Well, let's just shift gears a little bit. I got a few more shorter questions possibly that we can get through. One is kind of an easy one, but I'm curious about the answer. And that's a unit mix and unit size. So we thought everybody's going to work from home. Now bigger units are the thing. And then you say, well, affordability and the fact that people can't afford homes and that these are the lower income people and they can't afford to get a big unit. So what are you seeing in your client profiles and your loan applications and stuff in terms of unit mix? Is big the new small unit? Orange the new black? Go ahead. Yeah. Softball, you can hit it out of the park.
I would say that the unit mix, there was a lot of discussion about, we pre-pandemic, we were a lot of micro units. We don't see as many micro units any longer because the home work is this small, 400 square feet. So it's hard on people. And then also when people weren't going out as much. So I think that what we're seeing is it's still primarily ones and twos. Not too many threes. Threes are big units that could be for families, but for the average 1 to 2 people, it's 1 to 2 bedrooms. It really hasn't changed measurably for us.
Well, that's a nice transition then. So I think about the family, the working class, workforce housing, somebody with kids who are younger starting out and not being able to have this new home starter home market. They possibly need 3 bedrooms. So what is that product type? Is that why rental townhomes are kind of in vogue or catching vogue? Are you seeing any of those in your loan applications, rental townhomes or townhome communities?
Yes, I mean, there's a fair amount of that, especially in second ring and further out suburbs. And I think that's an emerging product type along with single family rentals, which, is really coming along too. And, we've spent some time studying that, making sure those projects are refinanceable by Fannie and Freddie, and maybe that can be a question the next panel can tackle. But I think that's definitely the case as home ownership either becomes out of reach financially, or younger families want the flexibility of not being tied down, or have the extra work. Lots of times these communities, all the yard work and snow shoveling, all that's taken care of. We really are seeing that emerge strongly.
And that's coming from the big banks. I got to think the mid-sized banks, that would be a good product type for you.
Yeah, we've seen some of those. I think some of that single family rental product though too is a lot of renter by choice. And frankly, that's, I think, some of where our multifamily demand is coming from as well. So whether it's someone who's ready to kind of move into that, I just don't want to deal with the maintenance anymore. Or you get people that are transitioning between jobs, or they know they might be here for 2 years and they're moving on to another market. So I think that's where a lot of that demand is really coming from, is people that really would rather just choose to rent rather than own a house.
And I would echo what Carl says on that. We've seen transactions, second tier suburbs, multifamily, the townhome product has worked super well.
I'm curious how the numbers work, because building an apartment building is one thing. You can get your head around what it costs per unit to build that, but start building single family homes and things with 4 walls or driveways and garages and all those sorts of things. How does the underwriting shake out? Are you finding that it's favorable enough to get deals done? Or are you turning some away?
No, it's still favorable. I don't think the numbers are that far off of a traditional multifamily deal, honestly.
Nobody else wants to comment. Everybody's I don't know yet, right? Is that your answer? You said you're looking at the single family home and you don't have an answer yet?
I think a lot of it depends on how it's laid out. Rental townhomes, I think in general, if they're designed efficiently, can be cheaper than per unit than some other product types, especially because they're likely located out in second in land costs.
Land cost and
driven by that
amenities.
primarily, right? So, but still able to get the rents to make those product types work. Single family, I don't know, the jury's probably still out there. There's been several communities delivered here in the metro, and I think it's going to be different from market to market there. But maybe to Carl's point, I think lots of those are renters by choice, maybe empty nesters. Some of those units tend to be smaller than, say, the largest suburban homes. So it could be folks downsizing, selling their home and wanting to latch onto that equity as part of the retirement plans and whatnot.
Are any of the ones you're looking at a temporary strategy? I'm gonna build single family homes for rent, and my exit strategy in 10 years is turn them into for sale? Or is this a permanent, we're gonna build this product type and that's the purpose for it for its lifetime?
The ones we've looked at are kind of more the latter. From an underwriting standpoint, we've looked at it that way and say, well, if this really just blew up and we had to sell these single family homes, what would that look like? And you can make those numbers work. But I think with the availability of the permanent financing, which has kind of been proven out now, that, yeah, these are really being built for, this is what the idea is. And we've seen them in other markets. I think this is maybe a more relatively new product for our market, but I think if you go to the Sun Belt and some southern states, this has been product that has been successful and it's been developed before.
I think most of the time, either they're on a single legal parcel, so it'd be pretty difficult to subdivide them after the fact, and they're probably zoned multifamily. At least the ones I've looked at, that would be pretty difficult to reverse course there. There's also from the street, they look like normal single family homes, but there are often some subtle design changes like exterior doors so that maintenance folks can get into your utility room and check your water heater and furnace and whatnot, that might make it less than ideal for repurposing as a pure single family ownership product.
Interesting. So that makes it a good spot for experienced developers and builders who know how to put secret doors in the utility room. Wonderful. Okay. Well, another I promised I wouldn't bring up politics. So I'm going to really try to beat around the edges. But for the record, I believe at our downtown development conference coming up, Mayor Fry is going to be here. So y'all should come and you can ask him about rent moratoriums and eviction moratoriums and rent controls and all that stuff. We won't ask this panel. But there is kind of one that's sort of politically related, and that's in regards to the rent assistance payments that don't appear to be materializing as quickly as I think lenders and landlords would like. Is there any pain in your portfolio related to late rent and the conundrum that that COVID's gotten us in? Or, and in your case, Joel, how is it affecting when you go to a perm situation?
Yeah, I don't know that it's as much leading to pain for the landlords, but in one sense, it's painful that it's taking as long as it is. That as when we're underwriting a lot of the stabilized deals, we're seeing the bad debt figures clipping along at a nominal pace, and then all of a sudden, I hate to say exploding, but you might have something that might have been a couple $1,000 that turns into $10,000, $20,000, $30,000, and you find out the explanation is that the tenants are applying for this assistance, and part of the applying process is they need to be late on their payments. And I think the idea was that they were going to be maybe late on their payments for a couple months, and it's turning into 5 or 6 months before it's processed. So trying to get lenders to understand, hopefully look through that process and understand that this particular tenant is going to hopefully get the assistance, get back current, and also get some assistance for the future, and that may also cover some utilities and things.
So this seems a little surreal to me though, but it sounds like you're saying there may be tenants out there who just have said, I can afford part of my rent, or maybe I can do next month, but I am told that I need to just purposely be behind here. that sounds like a scenario for a potential lot of bad things to happen. So how do you underwrite for that? How do you account for that?
Probably not getting full credit for it, but I mean, we have to go through and see who has been consistently behind and where it kind of turned the switch. Look for information from the case of majority of the time, the seller, to show that this group, this renter is trying to go through that process.
We'll talk about this on the next panel too, but it seems to me this is maybe the first time in history where lenders have had to look at a particular tenant and their payment history, not just the tenants as a whole or the portfolio as a whole or the building, but you're drilling down, right? I mean, that's what I'm hearing you say. Well, let's hit on another kind of shorter question. It seems to be the talk of the town these days is modular construction for apartments. Is that going to allow us to build a little bit cheaper, get to market faster? Is that a potential solution for Minneapolis? We know it's been big on the coast for a while, but how are your banks viewing modular? Are you in any deals? Have you looked at deals? Have you turned deals down or approved them?
So Bridgewater does have, right now we have 3 modular projects financed locally. And, you know, when you look at costs, they're not, to me, there's not significant cost savings. It's really delivery and product quality control. So we've analyzed that risk, the modular risk, and we've decided that it's appropriate as long as our underwriting meets normal multifamily standards and our developer has done their research and is comfortable. We're good with it.
Do you feel any nervousness about it being, you know, relatively young suppliers or new suppliers in the market?
You know, really there's one key provider right now that we've done a fair amount of due diligence on. And I think that's mitigated our concern over the construction and delivery risk.
Anybody else?
I mean, we're open to it. We've looked at a few deals. We've not financed any, but I would agree with what John said. I mean, I think our initial look at these was really to look really hard at the supplier and get comfortable and try to figure out what those risks are. I mean, as construction lender, we're always looking at who the general contractor is. And it's, you know, there's a lot of names around town that you're very familiar with, you have a lot of history with, so you don't have to dig super deep into it. But when you come up with a newer name or you've got someone that's a little bit newer, you just want to dig a little bit deeper and get comfortable with it. But I think, you know, just in trying to think about the product type, you know, is there a concern that this is an inferior product to a stick built on site? I think you get comfortable that, you know, the process and the product is good quality and you're not going to have those issues.
I agree with Carl. We have at US Bank, we have not completed any financing for a modular project, but are open to looking at it for the same reasons that Carl and John do.
We've been tracking it because we're the real estate journal. That's what we do, report the news. But there's 2 manufacturers now that have projects in the ground, and there's a third that just announced a contractor that's building a plant. So I think you're going to see more of it come across your desk. I hope that they go well and they're hiccup free. All right, let me just take a look at my notes. I know we have a few more things to talk about. Well, let's do this. We've got about 10 minutes left, and that's saving 5 minutes for questions. When I was doing a lot of these shows from my basement, I referred to myself as Nostradamus because I could predict the future because I had so many panelists that could just tell me what's going on and what's going to happen. So I want to put on our Johnny Carson hats and sort of predict the future. What do we see maybe 12 to 18 months out? And if you want to go 36 months out, what does the market look like? Are we kind of taken off here like we thought might happen after COVID, or are we constrained and still potentially worried about things, not coming exactly right out of this, I don't even know what you call the pandemic. Where do you see us going on multifamily finance?
I would guess we're going to see supply chain and commodity issues resolve themselves to the extent they haven't already over that time period. So I think some of that pressure out of out of project costing, and therefore financing comes out of play. I think most of that time period over the next 12 to 18 months will be used in CBD areas to absorb supply and burn off concessions. So I think rent growth will be muted there. And I think in other more areas where supply has been constrained, like the suburbs or just non-CBD markets, it's going to be off to the races in a really strong run from here.
So off to the races in terms of rent growth and development velocity, and let's rock and roll.
Right.
I like that. I like that prognostication. Let's do it. I'm going to learn to drive a backhoe. That's my thing for this afternoon. Let's go. Patty, how about you?
One of the areas that we have not talked about today in the multifamily arena is the age restricted senior, which is new. I guess it's a more prolific development type in the last 2 years, probably.
Can you
And so
describe that for me just real quick? When you say
So
age
it's
restricted, do you mean
55 and older, no services.
no services?
No services. So it's just another part of widening the senior housing platform. So this is active adults, no services, and we see quite a bit of that product. And I think that in 12 months from now, 2 years from now, I think that will continue to grow. I think there are a lot of people that through retirement want to be gone for 6 months, want to close the door, and there isn't as much single family. There aren't as many infill townhomes or larger units for them to be, then they don't want to take care of their home, as John had talked about. So I think the age restricted active adult, I think there'll be a lot more of that. And I think it'll be very successful.
Do you see deed restrictions? Do you see deed restrictions with those projects, or could the developer legally?
I've seen some deed restrictions,
Okay.
so it will have to stay as a senior. It depends on the city that it's being developed in.
Who would require the deed restriction? Is that something the developer wants to do, or is that
Keep it.
lenders, cities, who's?
Sometimes it's the city because they want to add a certain product type in order to keep a certain resident. So it's usually the city that would want that, because the developer will want to keep the array of opportunities for sale in the future. So they're going
For
to want to
sure.
make sure that it's as open and available for any type of buyer. But I think that's a hot product.
Now, is that urban infill or is that suburban? I think of,
I've seen
first of all,
more.
I'd like to retire and move south. So I understand that. But is it, if this older group, I mean, they really got hit by COVID hard. And I think that their perception of downtowns has changed. But there was a push for a long time for people to want to move back to the core where there were activities and things going on.
What I've seen and what we've seen at US Bank is first tier suburb. So you can still get into the urban areas quickly, and you still have the flexibility of the suburbs.
And you probably want to be next to your grandkids at that point too, right? So.
Right.
And they're all sizes. They're 100 units, they're 300 units. There's all different types.
So right here in Golden Valley, maybe some of this flex stuff that nobody's occupying, we gotta get my backhoe out and start doing.
Yeah, it's an interesting product. We've done several of these, a little more suburban, kind of two things that are interesting about that product. One is sometimes it's not necessarily a 12-month lease. Sometimes the tenants are asking for 24 or 36-month leases because they want to know that this is where they want to be and they want to be here for a long time. So kind of an interesting model for the developers to look at longer term leases. And then secondly, there's a lot of those, this is not the primary residence either for the people that are moving into those product types. They typically would have a house somewhere else, and this is a landing spot. They want to be back here and they be close to family, but they don't look at it as their primary residence either.
Yeah, here's an interesting comment from Jason Hale, I believe. Cities are requiring restrictions often because we need housing for seniors in order to free up the single family homes for the young families. So let's get you all what you want. You want to be able to leave 6 months out of the year and get that thing, but then also free up some inventory for it because we can't build new low cost housing. That's interesting. Okay, let's open it up for some questions here from the audience or online. I have access to the chat room up here, so feel free to ask online or in Live, there we go. I'll repeat for the online people.
Question for Joe on the 5 million gap in the national unit shortage. Do you see that extending your curves and projections? Do you see that shrinking, increasing, or staying about the same?
So do you want to just repeat the question?
Yeah, the question was related to the statement in my earlier about the 5 million units shortage in the country currently. I think at the development pace that we have, or do we see that shrinking or going or growing? I think at the current development cycle that we see it shrinking, but I think it's hard for them to dig into that much because we still have an expanding population. Maybe it's not as much as the economy needs because we're relying more on just national growth through not allowing a lot of people to move in from other international growth. It's more internal growth, which we'd like to see increase. But I think that number shrinks slightly, but I think it's hard for them to dig into it very much, especially with where costs are at. Just making sense of the single family, focusing mainly on the single family homes side of things. I think it's hard for them to keep up with where the slice of demand is, so to speak. Did that kind of answer the question?
I'm going to put my teacher glasses on. Anybody else in the audience have any questions? Anybody online? Okay, I've got one more then, and we might get to take a break a little bit early. This one, we talked on a prep call. You know what? I'm going to start recording the prep calls because sometimes those are the best conversations, and then we're going to charge money to watch them because they're even better sometimes. Because especially bankers, they don't want to. They're not always sure they're supposed to say stuff.
Let's definitely not talk about this. I remember.
Yeah, exactly, right? So I do have notes. But there's one here that we sort of said, it's an optional topic, and that's PACE financing. So it seemed like when I first heard about PACE that, wow, this almost seems like it's, debt, but it's equity. And well, this would be a wonderful way to sort of bridge a gap. Are you all looking at PACE financing? Is it fitting into your underwriting? And are you lending as a PACE lender or lending as a first mortgage with a PACE piece on it?
We do look at PACE as, it's hard to count it as equity in our world. We don't, we remain willing to look, and there will be deals that we will ultimately do with some PACE. I just yet to be convinced that it's a super viable source of equity in our deals.
Yeah, I'd agree. It's not equity, right? It's essentially a prior lien on the real estate. And I view it the same way as special assessments. That's something that's paid via real estate taxes that's senior to the mortgage on the property ultimately. So it is a source of funding other than debt, but it's typically more expensive than the construction debt. We're going to include it in the loan to value and the debt yield calculation because it's prior to the construction loan. So if that's the way most lenders address it, by counting it as a senior lien, why not just include it and borrow that money from your construction lender rather than a more expensive PACE financing, unless you find a lender that can squint and see it as equity as opposed to debt.
Well, and maybe expand on that and look at it outside of the lens of a lender. Just from an investor standpoint, I'm going to use really generic numbers here, but if you're layering PACE debt in, it might be a 6% pay on a 20% amortization. Not sure what the debt constant on that is, but that's
pretty high
in the 8s versus looking at even a conservative view on cap rates today. You're in the 5s. So borrowing that is going to devalue the sales price of your project, where it's viewed a little differently for office, industrial product types like that, where it's actually going on as the operating expenses, where you're getting reimbursed from the tenants. You can sell it there, and oftentimes the cost savings on the energy, which your tenants are reimbursing you for, Oftentimes it outweighs the cost of layering the debt on it. So I don't think it's been that prevalent in the multifamily industry just because of that dynamic.
I think what it was created for in terms of office buildings and industrial, it's fantastic, right? Because the energy market needed a mechanism to be able to replace all the light bulbs in a building and run that through to the tenants who are actually seeing the savings. Because as a landlord, why would you pay for that? You're not going to see the benefit of it. The tenants do. So it makes a lot of sense the way they structured it. But yeah, for apartments, Patty, you were going to chime in or no? Like, you wear your opinion on your face very well.
Don't touch.
It's a little bit of a square peg in a round hole. Well, I think I saw that there might have been something in the chat real quick. Okay. Oh, here we go. Justin Fincher, what are current interest rates and terms for an affordable housing project? What are current interest rates for construction loan? Is it still typically 24 months interest only? Well, you have 4 minutes. And you can duck and hide under the table if you want to.
So typically, at US Bank, just due to our size, we have an affordable housing group that specifically works with LIHTC, new market tax credits, all different types of tax credits. So I'm not up to speed on what the pricing would be for a tax credit transaction. And as for what's the pricing on a construction loan today, it's the same as, it hasn't changed very much. So it's so many different factors between loan to cost, who's the developer, what's the deal. But we typically have a 3-year construction loan, and frankly, the 3 years, it's usually interest only. So, and then once we would get into extension terms, then we would start an amortization. But our construction loans are interest only.
I agree there. One caveat I think I've seen now in some markets, either because of extended construction timelines or projected extended lease timelines, where we can see, a 4+1.
Yep.
But again, same
The
as you.
construction period,
Yeah. Same as you, whatever that initial loan term is, whether it's 3 or 4, that's IO. And then there's some financial covenant hurdles to access the extension option. And that's when the amortization would start.
I see interest rates over the next 36 months.
Question was back to your Johnny Carson hat. Do you see interest rates changing, fluctuating? What direction? What's the Fed going to do?
I could be as inaccurate as most economists, so I'll take a shot at that. 36 months out, I think you'll start to see, I think in the next 2 years, we'll start to see some really good growth that may get to the point where the Fed starts to want to hit the brakes, so to speak, and chip up on the federal funds rate. I see outside of rates just a lot of, let's call it deflationary type macro things. We've got cheap global labor, cheap energy. We really don't have enough growth in the U.S. economy to really spur a lot of inflation. So you hear it all the time, and rates have to go up, right? They have to go up. But I think all of that encompassing keeps them in check. Short-term rates probably go up at some point, but I don't see it where we're getting to a federal funds rate of 3-4% anytime in the near future, because of those macro events that are out there. Now, that doesn't always jive with policy. They have their dual mandate of full employment and keeping inflation in check. But I think a lot of those macro events keep commodity prices and things like that outside of what we're seeing right now. I think it keeps it in check long term.
So yesterday they talked about that there would be possible easing of the federal stimulus to the economy. Do you think that will? Sorry, maybe I'm not supposed to ask you questions.
No. And this is Joel opinion, nothing CBRE. I don't want to get in trouble with making predictions. That's where it starts to get off of basically zero of the federal funds rate, where I think if you look at the forward dot plot predictions from the Fed chairs that's moving forward. Now they have it in, I believe, the median is third quarter of 2022 when they raise it to 25 basis points. So that's the first step, and that's, you can view it two ways. It's confidence that the economy is going in the direction that they want it to. If we're still sitting here 3 years from now and it hasn't moved, that's probably a sign that the economy isn't moving as far forward as they'd like. And that might be things of unknown creeping in again. Is there another variant that comes out outside the Delta variant and continues to have people not wanting to go back into the offices, not wanting to do things along those lines? So
We don't allow that.
black swan events. So.
No more, please. Okay, well, we're running out of time. I want to follow up on that about inflation. The government needs two things desperately. The United States Treasury does. They need inflation to get out of the debt issue they're in, and they need low interest rates in order to continue to pay out that cheap debt. I don't see it going anywhere.
Until we get more robust immigration. I don't know that's.
I don't know. Yeah, I don't know what the trigger is going to be, but we need to inflate the heck out of the dollar, and none of us are going to enjoy that time frame. So let's buy more real estate because that's the best inflation hedge, right? Well, let's give this group before you clap though. I just want to say thank you to all of you because bankers are notoriously, don't like necessarily public speaking, and it's really nice for you to come up here and share your thoughts and what's going on kind of behind closed doors. It really helps us in the community understand what the lending world is like. So round of applause for these people. Thank them for coming out. Okay, we're going to take a short 10-15 minute break. There's coffee out in the hallway.
Thanks, Todd.
Yeah, thanks. Nice work. Nice shirt. Thank you. You guys look sharp. I feel like I've switched to jeans and shorts and polo shirts.
I couldn't go totally.
It's hard, isn't it? It's hard to go back.
No,
Are you,
good job.
Are you in the office?
I am in the
5 days?
office. Yes.
Okay.
Yeah.
Most
I'm
people
much more
are.
productive. Yeah,
You are.
Bridgewater we're pretty fully.
Yeah.
Yeah.
Well, I know
So
when
the
I
people
call
that
now,
work, the people that work for me, they can be, the kind of the stated requirement is 3 days in the office, 2 days remote, which helps accommodate like a lot of our operations people. They're dealing with kids.
Yep.
Yeah.
no, I know when I call when I have something going on with the checking account or anything,
Yeah.
you can tell sometimes they're at home and it was just fine. It's like this camaraderie that we all have now
Yeah,
that work from home.
I know. Well, it's a good skill we all had to learn. Right?
Yeah, but I don't think it would have been okay for a banker to work from home 3 years ago.
No, we're attorneys.
Or attorneys.
Yeah, so I have a lot of attorneys that are buddies.
Yeah.
They may never go back.
Right.
You know?
I'm like, some days I'm like, I'm on the pontoon right now. I'm just letting you know, I'm working, but
Right, right.
It's not what I
and
used to
it'll allow me to sneak down to Florida this year again.
yes, right.
For, I'm gonna drive.
Do you have a house in Florida?
I do in St. Augustine.
Okay, where's that?
Northeastern Florida.
Okay, we're looking. Why did you
So-
choose that?
Okay. You should.
I've
it's
heard
East
that
Coast.
northeast, okay,
Northeast Florida is a great value. in
north
general.
of
So I'm
Daytona.
north of Daytona.
Yeah,
And
Because
south of
Daytona's trash.
Jacksonville. Yeah, so St. Augustine Beach
Okay.
so I'm 2,000 feet off the ocean.
Okay,
And it's a barrier island.
is it
that I'm
a
on.
soft sand or is it a hard?
So
sand
we
like
have
Daytona?
a solid sand, which
Okay.
gives you two benefits.
Yeah.
Super flat.
Right.
You can bike on it,
Yeah.
which is super nice.
Yeah. I
And you
thought of
can
that.
walk and run.
Right. that's a
And
good point.
and we have a dog-friendly beach,
Okay.
incredibly clean.
Yeah.
No spring breakers, because St. Augustine Beach, beach patrol, pretty aggressive at no alcohol. Yeah, yeah.
Well, I don't know if my wife and I can do that.
So what
part.
we do
We'd have
is
to- yeah,
you
yeah,
fill up
right,
your,
that's what I'm thinking. They're not checking me either.
Yeah.
They don't care about you and I.
I know. Yeah,
We've been looking at the Panhandle, and there's an area called
Yeah.
38.
yeah,
You've seen that,
yeah.
but the prices have gone up.
Well,
50.
it's just so expensive.
So a house we're looking at that's, we thought, 1.5, 1.4 is now 2.2. And we were like, I can't justify it. That's a lot.
I'll send you a link to an article that was just in the St. Augustine
I'd love to see it.
paper, and it is worth a visit. I just hosted clients, a couple of my banking buddies 2 weeks ago.
Yeah.
We went down because we couldn't go to Canada fishing, so we went down for a fishing trip. So we did 2 days of ocean fishing. We played, I said, who wants to go play pickleball?
Right.
And no one had played. And
Oh, and then
we
they
went,
love it.
and they made me go back like
Yeah,
3
for sure.
times.
Yes.
And I think of this, there's like 3 coming back
Yeah.
to look with their wives
Yeah.
because they had such a great time.
Yeah. Well, pickleball and fishing.
Yeah.
You can't
And our
go
home
wrong.
sits, even though it's super close to the ocean.
Yeah.
It sits in the giant southern, I have these 5 giant southern oaks with hanging moss.
Oh.
So you get incredible shade. And having, from Minnesota, go sit on a beach for 5 hours
Yeah.
and bake.
Yeah.
You want to go back to your house and sit in the
Oh,
backyard
that makes
in
sense.
shade. It's super comfortable. So, yeah. When you do get down,
I forget people are probably listening to us talk.
so
So,
we'll figure it out.
Yeah.
I'll send you some scoop and then. Bring it back. I don't want to make it. So it ends up being.
All right, let's roll into panel 2. We got a good panel coming up, so everybody wants to find their seats. I'll adjust here. Lucas Wilson, Mike, Dan Brock, if you're in the house, let's come up on stage. Yeah, that's a big step. Good. Don't fall. Don't trip. There are stairs. Feel free. The finance conference is like this versus office or industrial. Everybody actually sits down and quiets down. I don't have to use my teacher voice, Jeff. Find your seats. Bueller. Online people, time to get your screens back on. Jay, have we done 3 questions so far or 4? 3. So if you haven't answered 3 poll questions, make a note in the chat room right now and we'll try to rescue you. So that we'll try to rescue your CE and see if there's a technical issue or something. So you should have answered 3 poll questions. All right, everybody up here, we're ready to roll. Everybody found their seats. Everybody found a cup of coffee, ready to have some more entertaining fun. HUD, Fannie, Freddie, this stuff is, it's not technical at all, right? This is easy peasy, lemon squeezy. Well, let's, so I'm going to do the same thing I did on the last panel. I'm Todd Phillips. I'll give you a little bit more on my background. I did play multifamily developer for a while and I still kick it around. So I know a little bit. I've done a few projects. I'm also an attorney CPA by training. But these days I mostly just host events like this and work with Jeff and Jay, run the Real Estate Journal. So we're going to go down the line. Brock, start with you. Just tell us your company, where you work, maybe what you're up to these days in terms of, are you in the office? Are you not in the office, still remote? How active are you in the market right now? Are things back and hot? And how are things going just generally at your company? So we'll just kind of go down the line, but Brock, start with you.
I'm Brock Affey with JLL Capital Markets. JLL is the number one debt originator nationally, placed about $58 billion of debt in 2019. Prior to that, in 2020, prior to that in 2019, pre-COVID, our firm placed almost $100 billion in debt. And of that 58 billion last year, roughly half of that was on multifamily, inclusive of debt and equity placements. And that's across, Fannie, Freddie, HUD, life insurance companies, banks, debt funds, really covering all the lender types. I'm part of a team here in the Twin Cities that's inclusive of the debt placement side. We're very active in joint venture equity placements, especially for ground up multifamily properties. And then we also have investment sales for both multifamily and commercial. And I recently, I'm a Minnesota native, but had been living in Denver, Colorado for the last 13 years, recently transferred back home here. And I've been working in the office every day since I came here in April.
Is that because you wanted to get reacclimated, or just because Minnesota is miserable compared to Colorado and you might as well be in the office?
I just enjoy being around the team and the people and the energy, and I collaborate very closely with our investment sales teams. So I just think you lose that in a remote setting.
I think we're going to hear a lot more of that going forward. All right, moving on our way down.
I'm Wilson Mulder with Greystone out of Minneapolis. We are focused on agency originations across Fannie, Freddie, and HUD. In Minneapolis, we are focused on small loans, million plus, but play in the large loan space as well. As a company, we do around 30 billion originations annually, with pretty even split between all three of the agencies. Outside of that, I'm in the office when I feel like it, I guess, right now. And it's a small team in Minneapolis, just me and two other guys, focused on Minnesota, Minneapolis and outstate, and South Florida as well.
How many times that sport coat been out of your closet this year?
Once.
All right, let's keep going down the line.
Lucas Goring, I'm at Bellwether in Minneapolis, and we do a lot of the same stuff as these guys. So it's Fannie, Freddie, HUD, life insurance company, banks, equity, debt funds. Right now, it's a lot of apartments. I've been coming into the office about a year and a half, about every day, mainly because I've got an 11 and a 9-year-old kid at home. So it's easier to get out of the house and go into work and see all the smiling faces of coworkers, and it's a better environment than sitting at home.
So the 11 and 9-year-old, are they doing online school, or are they back?
No, they are in
live?
school now, so the time in the office is
It's a little better, a little more
bit, yeah.
manageable. All right, I think it's Mike. There you go.
Hi, I'm Mike Bazans. I'm with Collier's Mortgage. We are a FHA and Fannie Mae lender. We're also a USDA lender, and through some of our affiliates, we also do bank placements, debt funds, life insurance companies. So really the whole gamut. Until about 15 months ago, we were the Doherty family of companies, and we've partnered with Collier's, and so that's an exciting new platform for us. We have a servicing portfolio of about 8.9 billion total, and we work nationally with headquarters in Minneapolis and offices throughout the country. I am going into the office pretty much every day. I just do better in the office rather than sitting at home, and it's nice to be around some people. So been mostly in the office, but we're kind of on a voluntary return as well.
Right, Dan, last but certainly not least.
Appreciate that. I'm Dan Treble. I'm with Northmark, manage our Minneapolis office, which is our headquarters. We've got about, I think 38 debt and equity offices nationally. And I think we're up to about 18 investment sales offices now. That's been within the last 2-3 years. We've rolled that out, starting in Phoenix and kind of now through the Smile, through the South and coming up the Eastern Seaboard now. But that's a big growth portion of our company currently, and we hope to have investment sales here in Minneapolis at some point in not too distant future. We manage about close to a $70 billion servicing portfolio here in Minneapolis. We're doing about $20 billion a year in production. You know, again, kind of across the spectrum. We're Fannie, Freddie, HUD, as well as, you know, we're the largest life company servicer for life company loans, privately held by the Polat family, and doing plenty of bank and debt fund and credit union origination as well. They have a growing equity group within Northmark that's out arranging joint venture equity across the country. You know, I'm part of a group of I guess 6 of us now here, and six people on the production side and some analysts here in Minneapolis. As far as back to work, we're I think fairly fortunate where you know the folks in my group don't have the small kids, which either keeps you at home or keeps you away from home. I like my kids, but I'd love to spend more time with them. But they're in high school, so they don't want to be around me. So we've been back in the office now for, geez, I don't know, well over a year, and we're pretty much there every day. We had a couple 2-week hiatuses as our interns went to college and came back with COVID, but other than that, we've been in the office.
Let's do a show of hands. First round of hands. If you're back in the office full-time, 5 days a week, let's go. I miss it. I need to be there. That's a lot. I wonder if it's the finance industry. Then the second question is, I'm in and out. I float back and forth 2 or 3 days a week, 2 or 3 days in the office. That's me. So I'm really raising my hand smaller. How about still 100% remote? Yes, we're all a hardworking group. I like Minnesotans. Let's get back to work, get back in the office and maybe put a sport coat on. But I have noticed that the dress styles have completely changed. By the way, Jay and I were just commenting on that. I think we've gone casual and we're staying there. Everybody agree? Nobody has a tie on but me today. All right. Well, let's roll into some questions. You know, just like the last panel, I won't let you off super easy, but we'll start out just with general. Let's talk about the permanent debt market and focus a little bit on the agency type takeout. So where is the market at today? And again, I asked the last panel, I feel like we were frothy 2 years ago. And for some reason, we never took our foot off the gas in COVID. The multifamily market just kept chugging along. I remember doing webinar after webinar, people saying, okay, next month. Oh no, it's going to be next month. We're going to have fallout next month. And that went on through June, July, August, and it just kept going. And collections stayed high and the market kept kind of rocking. So is that what you're seeing? Or tell me and give me an update on where the market's at today, just general questions. We'll start down here and just work our way down the line. So Brock, you get the first guy.
Yeah, I mean, I think the market's very healthy. Right now, you know, there's more liquidity in the market, frankly, probably than pre-COVID. You know, the availability of debt, the options of debt. There's really an option for anything, you know, whatever your business plan may be. So, you know, obviously Freddie, Fannie have been extremely active as they always are, but they sometimes run into their cap. And then they'll slow things down, which we saw with Freddie more recently. But then you have the life insurance companies, which are, you know, looking to aggressively put money out on, you know, multifamily properties primarily and industrial as well. And so it's, you know, it's a good time to be a borrower, and all of that is kind of relating to, you know, compression in spreads and overall interest rates.
So you said Freddie's dialed back just a little bit here recently, but life companies are filling that gap? Is that
You know,
today?
just, I guess, just, you know, for everyone's reference, they each had a $70 billion cap on the originations, Freddie and Fannie. And, you know, Freddie came out pretty hot in the spring and into the summer and started having concerns about, you know, hitting that cap early. And so really they throttled their originations by increasing their spreads pretty dramatically and kind of being more selective on waivers that they would grant. So, you know, we've seen a lot, we've seen Fannie kind of pick up a lot more business over the summer, but Freddie did just announce a 10 basis point decrease in their spreads. I think it was yesterday. So, you know, I anticipate that, you know, they feel like they have, you know, enough capacity for the remainder of the year and that they'll start getting more competitive.
Interesting. Wilson.
So I'll reiterate that it seems healthy. All the agencies are actively lending and digging into win mission-rich business and support affordable housing. Fannie and Freddie are managing to their lending cap, and they'll come in, you know, right there, and soon enough probably start gearing up for 2022.
Well, Lucas, let's change the tone a little bit. Who's the hot money right now out of everybody that's been mentioned so far?
Yeah, I would say there's money everywhere. Whatever you want, everything's for sale. We're seeing a lot of life companies get a little bit creative on getting deals a little bit earlier than waiting for stabilization. So we talked in the first panel talked about that a little bit, and there's some advantages and disadvantages to taking your bank loan out earlier. Like a debt fund will give you more proceeds, or life insurance company will lock your rate right away, so you don't have to wait out until you're stabilized. But if you're waiting it out, the agencies with all the interest only and 75 or 80% of leverage, it helps a lot of business plans when the rates are high 2s or low 3s.
Yeah, we got to get into that because that just, aside from the fact that you can be taken out at certificate of occupancy, anything with a 2 in it is patently ridiculous, but apparently that's reality.
So I'll go kind of the opposite of getting creative and talk about HUD, but the volume on the HUD side has continued to grow as well. I mean, fiscal year 2021, which ends at the end of this month, HUD's projecting 31.8 billion, which is up from 21.7 billion last year. So extremely low interest rates, you know, low 2s on the acquisition refis is really driving a lot of business that direction. That and an announcement that was somewhat overshadowed by COVID, but HUD's elimination of what was called their 3-year rule has allowed HUD to come into the takeout market and refinance projects once they hit stabilization. So we've seen that really open, and I think almost every HUD lender in the country is seeing record volume, record demand for the HUD program. So a lot of money out there in that regard as well.
Yeah, I mean, I think, you know, we all kind of play in the same space here to a certain extent. Certainly the agencies, if you're looking for high leverage and interest only, you know, with a relatively kind of, you know, what I'd call midterm, you know, anywhere from 7 to 15 years, the agencies are kind of the best game in town, and HUD of course will go longer. You know, we've seen, I guess, in addition to that, you know, the life companies are, it's all a relative value game for them. So they need to invest, you know, you pay your premiums, they've got a bucket of money sitting over here, they have to invest it somewhere, right? And where do you do that and still feel like you're protected on the risk spectrum? And so a good portion of that's going into real estate, because even though the spreads and the rates are low, it's still, you know, relatively appealing from a yield standpoint. And within that, they're all chasing industrial and they're all chasing apartments. And, you know, nobody is, well, life companies aren't great at kind of stepping onto the forefront, I guess, early. So they're kind of, they're in wait and see mode a little bit on office. So being a little conservative there. And hotels, you know, is largely untouchable except in certain circumstances. Retail, if it's grocery anchored. So, you know, the long and short of it is that, you know, which is normally a good piece of that pie, the life companies just aren't chasing that quite as aggressively. And so they're going after industrial, but nobody can find enough industrial. So they're going after multifamily. And so those spreads are super aggressive. Can't quite get the same leverage and interest only provisions that you would with the agencies. But if you're looking for long-term money at moderate leverage, you know, you can do 30-year deals. We just locked one at, you know, 260 something for fixed for 30 years. And so, you know, that money's super cheap. The other thing we've seen, normally our business is, you know, especially now with investment sales, which some of these guys have investment sales platforms as well. And, you know, that was historically, it's always the agencies because everybody's looking for leverage. And what we've seen, especially through the Sun Belt, is with the way rents are increasing because of the population shift and the health of those markets, people are going away from the longer term Fannie Freddie HUD type programs and going towards debt funds, which are, you know, which will do a, you know, 3 to 5 year floating rate deal. It starts at basically 3% today, but it'll give you 80% leverage on the purchase. And they'll also give you some future fundings if you're looking to make improvements as you go to try to pop rents. The interesting piece to that is they're popping rents so fast, they don't have to, you know, the buyers don't have to invest anything into the properties because they're already getting the pop on the turnover. But that's become a bigger part of our business nationally. You know, it's not quite as prevalent here in the Twin Cities because I think people tend to bid up the value add piece to the point where the value's already been added kind of. And then I think it's just a sort of different profile with Minnesota borrowers, but that's also hot money these days.
Well, you all don't seem to be shy about talking about rates and term and proceeds as the first panel. So let's just talk about, have a little fun. What is the most ridiculous number you've seen in terms of proceeds or rates, or you know, what's the most fun one you've seen? We'll just go down the line to come back this way. So start with Dan.
Okay. My home mortgage is 199. Felt like that was pretty good. Yeah, I mean, I think that with the deal that I mentioned, you know, a 30-year fixed rate deal at 60+% is, you know, sub 275. And that to me is sort of off the charts, you know, and that's just kind of, it is what it is right now. And, you know, if you talk about cap rates, some of these different things, I think, you know, you're seeing full term IO at pretty full leverage. And, you know, so those kind of components to the deals are I think what's really, I think you said it best. It's good time
Full
to-
term
good time-
IO, you mean like a 10-year loan?
Yeah, 10-year loan, 65%, and you're going full term IO.
65%. So they're
So-
underwriting that 65% at the end. It would be compared to maybe an amortized.
Yeah.
That's generous.
Yeah, good money. You said it best. Good time to be a borrower.
I think from the HUD perspective, the lowest rate we have seen is on a refinance. It was a cash out refinance, 35-year loan. I think the rate was 195 plus a 25 basis point MIP because it was an affordable transaction. It was a refi after a moderate renovation. Rates today are in the low twos on the HUD side, probably 225 or below. And then if you're affordable or green, that MIP is 25 basis points as well. On a new construction side, we recently locked a 273 interest rate. That's a 40-year construction to permanent loan. So a drawdown construction loan that converts to permanent, 273 plus on that 125 basis points MIP because they're building to a national green building standard. So HUD, and that is also 85% loan to cost. So on the FHA side, obviously the highest leverage, probably the lowest interest rates out there because of the Ginnie Mae securitization. Little bit of a process that comes along with HUD, but if you can work through the process, some pretty amazing terms out there right now.
To the lowest rate we've seen on from a life company perspective, the low leverage, larger loan amounts, they can get down to the 115, 120 over the 10-year treasury. And we had one, and treasuries were at about 115 at the time. And I think the all-in rate was high 220s for 10 years.
Yeah, can't compete with HUD rates right now. But I mean, still winning good business with low leverage, high LTV deals with I think on Fannie deals we're quoting with some affordability and high twos with a lot of interest only on it. So
nobody's talked LTV. What's the high water mark for proceeds? Especially cash out. Is cash out happening?
cash out, I mean, yeah,
Yeah.
you're still at 75% cash
75.
out, 80% in some programs with Freddie.
Wow. So the days of, I think I remember days when it got really nuts and people were doing 100%, but with some mezz and stuff, it just got weird, but sounds like rate is where the shock is today.
Rate is acquisition. We did a Fannie Mae loan last year that turned out to be about 83% of cost by building up some improvements, funding stuff ahead of time. So that was our high water mark.
That's aggressive. Let's have some fun with the audience here. Okay, so raise your hand if that conversation you thought would never happen in your entire lifetime. So you all, knew better than I did. I remember when rates are in the 4s and we said, there's no way anything's going ever below 4. And then there's no way it's going below 3. We'll never see anything with a 2 on it. And you all brought up something that you heard about with a 1 in front of it. So it's a fun time. I think we'll be telling our grandkids about this, or maybe we won't. Maybe this is the new normal.
To
Okay.
Dan's point about the life insurance companies, their alternative investments are corporate bonds. And those are single digits. Those are below 1. So they're trying to get a little premium over that. And that's what they're comparing it against. So if they can get a 40 or 50 basis point bump over those corporate bonds, they think they're winning. And it's matching up their investments on the backside. So the rates sound really low, but it's better investing for them than what they're getting without doing mortgages.
Think about that though for a second. If I handed each of you $100 bill and I said, come back to me next year and let me know what you did with that, and you came back with $1 of profit, how patently ridiculous to be. I mean, really, a year you generated $1. Wow, let's.
You want to try it?
What's that?
You want to try it?
Yeah, exactly. Yeah. Well, I'd be game. What do you think you could generate? I mean, honestly, it does, once we get up to a larger scale on these dollar amounts, it does seem sort of like a surreal universe that we happen to be living in. Well, that's the fun stuff. Let's talk about what are the challenges you're facing right now. Not everything's easy. I've done a few deals in my lifetime, and I know not every deal that you want to have closes, and not every deal you quote wins. So where are the challenges in the market right now, or in some of the things you're seeing?
I think challenge when you asked a question about what's the maximum LTV you're seeing. Well, I think what we're seeing is there's a constraint to the LTV right now, and that's really driven by what we talked about on the last panel, debt yield and debt service coverage. Agencies don't really look at debt yield, so they're really coverage driven and LTV driven. So you're often debt service coverage constrained. The life insurance companies are more and more looking at that debt yield, and as these cap rates drop, you're just seeing these LTVs get constrained. We're financing a deal right now. It's a 4 cap, and at a 7 debt yield, we're only getting to 50% leverage. So, and Dan mentioned it earlier, we're seeing these in the Sun Belt markets, and Denver, where I came from recently, these properties are trading at 3 cap, 3 to 3.25 cap. And to look at the kind of leverage you can get going in on that. And that's why a lot of these, borrowers are shifting to debt funds in those markets, just trying to get leverage going in. And then, and then they're underwriting 20% rent growth to try to get to their yields. So that's the challenge I see. And, lenders always tend to kind of lag the market. So at what point are they going to catch up and change their underwriting, so you can get more leverage?
Yeah, I mean, acquisitions have been difficult. 9 times out of 10, we're debt cover constrained. And just with pricing the way it is, a 4 cap deal doesn't make for the most financeable asset with the agencies.
Where's the debt coverage number at? That
Typically on an acquisition, 120, 125 at a minimum. And we're seeing 65% LTV caps with a 125 cover. And if you got a big pro forma in your underwriting on the acquisition, that might not be ready for perm debt with the agencies yet.
with all the money chasing real estate, why are we at 125 debt cover? Why are we not talking 115? I mean, I'm talking like a borrower here, but come on, Dan, I see you smiling. Give me to 115. What's the holdup?
Conservative
If it's a
underwriting.
2.5% rate, you can't make it work at 120. It's a challenge.
It's a good point. Well taken, right? When the number's nil, you got to be able to do the math.
No, and I mean, I say that a little bit in jest, but I think the, unaffordable product, and that's when you start seeing the debt coverages cram down. But I think, at least so far, everyone's kind of holding serve on the 125 or maybe some cases 120, just because it's prudent, and responsible, right? I mean, and they're doing it on today's numbers, so it's not as much for the most part. The permanent lenders are typically going with today's numbers. And so we're not quite back where we were, I don't think, in 06 and 07, where people were kind of projecting out 3 years, taking a 120 on that number, which may or may not ever happen, right? So,
Well, we were talking 20% rent growth on at this end.
well, then, yeah, I guess switch gears back to the debt funds or banks, which are, inherently more forward-looking, and they do have the ability to, with market support, say that, hey, we're going to get 7% rent growth or 20% rent, whatever the number is. But for the most part, life companies, agencies are more, looking at today or looking in the rearview mirror versus projecting forward.
Yeah, go ahead, Mike, if you got something to add.
I was just gonna say on the debt cover side, HUD will actually give you 118 and 115 if you're affordable. And with that program, because of the low rates, we aren't seeing as many debt cover constrained loans. We're seeing them generally on the permanent side limited by 80% if you're cash out or 85% if you're not, just because those rates being low. So really the challenge we're seeing is timing relative to many of the other products that are out there. If you're looking nationally, HUD's got, processing queues in other parts of the country that add a few months. Locally here, we're very lucky. We have a high performing office. And so they're meeting their timeframes. They're putting projects into processing right away, which is helping. But, I think the biggest thing is just HUD handling the volume that it's got going right now.
This is the only room where high performing means you're really good at processing paperwork.
Yeah.
Outside of this group, they might mean something like sports or something like that, but we're good at processing. Let's go. Sorry, I interrupted.
Collections have been another challenge through COVID and with agency loans that they're gonna dive into tenants and who's paying and who's not paying. We had an acquisition that fell apart with a Fannie Mae loan because the physical occupancy was 92%, but they had another 10 to 12% of tenants that weren't paying rent. So we're underwriting it down to about a 20% vacancy, and those numbers don't work.
So pre-COVID, let's dig into that for 1 second. Pre-COVID, how many vacant tenants would have made you, delinquent tenants would have made you queasy? Was it 1 or 2? And now we're seeing, 1%, maybe you just kind of, no big deal. That's the apartment market. Where does that break point where you say, ooh, oh, that's a lot? And then how does the government delay play into all of that? Are you, and the rental assistance that may make up that gap? How's that dynamic all working?
Well, the agencies are really focused on rent collections, backward looking. So, they were always looking at, your in-place rents, less your concessions, vacancy, and bad debt. And they would just look at a trailing 12-month, statement and see what that bad debt is and kind of generally underwrite to the trailing 3 average, assuming that the trend was increasing. But, during COVID, what people started to realize, what the agency started to realize was, well, maybe not everyone was booking that bad debt until it actually occurred. So the new phenomenon is when we go in to submit a loan for a quote on agency quote, we have to provide an age receivables report, and it'll show you the 0 to 30, 30, 60, so on and so forth. And they're really focused on that 60 to 90 days and that trend of collections on those receivables. And if that balance is kind of flat to increasing, they're going to factor that into the underwritten bad debt.
So are you able to make a case then for these people who have applied for assistance and they're just waiting on assistance, or is that just put the blinders on? We're looking at the numbers only right now.
I would say in my experience, they're more just looking at what those receivables are.
Yeah.
I don't know, maybe someone else has seen something different.
I would agree because you're gonna look at that tenant that hasn't paid rent for 10 months. You're gonna get a big pop when they get their check, but what's gonna keep them paying going forward? So yes, you're gonna collect that money, but it's unlikely they're gonna continue to pay.
I mean, prior to COVID, with HUD requiring a 7% vacancy rate, you really never, you had very few situations where you ever had to stress over that, because you look at a rent roll and you look at collections, and generally it would be above that. But what you're seeing now is you'll get a rent roll that shows 95% occupancy, but that rent roll doesn't tie out to the historical statements because of the collections. So you really are having to dig in and try to figure out, what is collected, what's going to be collectible. And I think the agencies and HUD are getting conservative in how they look at that, to make sure we're not underwriting too aggressive on the income side, because it is backwards looking more than it is forward looking.
Yeah, I think the only thing I'd add to that is, this phenomenon with the rent help is, if and this is kind of an immediate concern, it'll probably wash itself out, but on deals that are sort of in process where tenants are applying for that, the agency itself is telling the tenants, okay, you're in our queue, you're in processing, so eventually you're going to get the money. So in the meantime, don't make any payments, which then sort of further exacerbates the problem with trying to refinance. And again, that's kind of a, I don't know, but laser focused on, the agencies tend to be pretty focused on the trailing 3 months collections. But if you're, if your tenants if you started working with your tenants to get the money through rent help in July, well, if your July numbers, because the tenants were told not to make payments in July, even if they could, are now a lot lower, and that screws some things up. But that's again, a short-term issue that'll probably resolve itself, but an issue nonetheless.
Well, Mike, can we go back to you for a second? And you had mentioned a little while ago, I'm backing up a little bit, about if you had affordable, there was another rate, so you could drop in rate. And is that a percentage affordable, or is that fully affordable? And then I want that to play into the entire panel about the mix of affordability versus market rate. And I think there's some dynamic in the market right now about a push towards affordable on the lender side, and the fallout from that. So we'll start with Mike.
Sure. So FHA adjusts its pricing for affordability or green through the MIP. So the interest rate itself is not necessarily driven by affordability, although the buyer of the Ginnie may be more interested or more aggressive if you're in a CRA market or you've got affordability. But the MIP is really how HUD manages that. And if you're a market rate refinance, the MIP is 60 basis points. If you're a market rate new construction, it's 65. However, if you're affordable, so 10%, between 10% and 90% of your units, subject to either LIHTC restrictions or a Section 8 HAP contract for more than 15 years, that gets reduced from 60 for a refinance to 35. And it's 35 for new construction as well. If you're more than 90% affordable, you fall into the bucket that HUD calls broadly affordable. And that's a 25 basis point MIP. So a fairly significant reduction over just a standard market rate project. Now there's another category of green MIP. And that's generally in a new construction, if you build to a third-party green standard, or on a refinance, if you already have a green standard, or you retrofit to qualify for one, that MIP is 25 as well. HUD has made it a little bit more challenging for a refinance to get that reduced MIP. So if you're newly constructed, HUD's looking for you to have built to a third-party green standard, or there's a 2-year window where Energy Star still applies, but that's really how HUD incentivizes the pricing. On the leverage side, affordable properties go up to 87% leverage, 115 cover. And then if you're 90% affordable, that's 90% leverage and 111 debt service coverage. We generally don't see any loans with leverage that high because those are generally tax credit projects that have other constraints and other funders, but that is what the HUD programs allow. And I know that Fannie and Freddie and others, use different pricing strategies on the affordable side, but MIP is really the tool that HUD can use.
Anybody feel free to take that in another direction and let's just, and talk generally affordable, the market and maybe the consternation between affordable and market rate.
So I guess Fannie and Freddie similarly have programmatic buckets if you meet affordable requirements, be it either a housing assistance payment contract, deed restriction, LIHTC, or just market affordable rents based on census tract AMI.
So is the political pressure right now, I hear the president talking about affordable housing, and are the agencies going to start to increase those buckets at the maybe decrease of the market rate buckets? Do we see anything like that happening?
So that's speculation for now, but the FHFA guidance is that Fannie and Freddie need to increase their affordable units financed by 35% over the next 3 years. Yet to be seen how that plays out with any cap or anything like that. But beyond that, the agencies both gained $250 million to buy LIHTC equity and help bridge some of the gaps in that market. So yeah, there's a big push.
And assuming that it's not being built at the same rate, because building affordable housing is still difficult, right? You're constrained by LIHTC and land and all kinds of other factors. Does that then, what is that, if you prognosticate, put your Johnny Carson hat on, how does that affect the pricing on that then? Does the bottom fall out even further? No predictions, anyone? I'm going to go out on a limb and say we're going to see some more ones, but that's just my guess.
We can hope.
Well, that would be fun, wouldn't it? If you're online, the CE question number 5 just went live, so make sure you're answering those. Okay, let's get back to this debt yield, because on our prep call, again, where all the good information is, we should just invite you all to the prep calls. We were talking debt constraint numbers, or I'm sorry, debt yield numbers constraining the loan at 8%. But on our call, we talked about, things that are in the 7s. Where are you seeing debt yield right now from your sources, and is it moving southward?
Yeah, I would say life insurance companies, at least in this market, generally stick to a 7 debt yield. Now, we also are financing a lot of deals that are in lease up, and life insurance companies, if the lease up has gone well, there's been minimal concessions, they'll consider that. And so we've done deals where it's been maybe a low 6, mid 6 going in, but trending towards, above a 7. I would say in other markets nationally, again, kind of looking at where the cap rates are lower, we're seeing some of the life insurance go down to 6.5, maybe even low 6 debt yield. Debt funds, I would say they're not as focused on it going in, more looking at it on the exit and kind of looking at how do they get taken out of their loan. And so they're looking at kind of year 3, year 4 cash flow and want to solve to stabilize debt yield in the 6 to 6.5% range. Agencies don't really look at debt yield per se. And, I think banks, they kind of talked before. Yeah. I think generally they're looking at 8, but some will go below that.
We asked this question in the polls, but I didn't ask any of you. So we'll just do a simple raise of hands again. But before today, raise your hand. I'm comfortable with debt yield. I calculate it all the time. I totally get it. And then the next set of hands is like me. This was a brand new concept. I haven't done any multifamily in a while. Like, what debt yield? What is that? If you're with me, 1, 2. This is a sophisticated crowd. I really appreciate you all. All right. Anybody else want to talk on that? Where are you at? Dan, Mike, do you HUD not touch debt yield?
Debt yield is not a used concept on the HUD side.
Nice. So that button isn't on your calculator.
No.
Nice.
No, I think that's a good summary.
Yeah.
I think, maybe one additional comment would be that because the agencies aren't focused on debt yield on the takeout, that, then banks are maybe a little more willing to size their construction loan and the, ultimate take out of their construction loan on an agency underwriting, which isn't quite as, I guess, hard and fast on the debt yield side because they think they're going to get taken up by the agencies.
All right, so let's move back into affordability. I've got some notes here. And somebody in our prep call, and I took great notes, I feel like, but I didn't take names on this SIA sponsor initiated affordability to get better pricing. Was that you, Mike? Or was that?
That was me.
Okay.
That was a property that had very low rents going in, and Fannie Mae had a program, the SIA sponsor initiated affordability. So they put a deed or inside their loan docs to agree to keep 20% of the units at 80% AMI. And we got a pretty significant pricing discount on it. It was 15 basis points on a $10 million deal. So it saved them 15 grand a year. And that property, none of the rents would ever hit 60% AMI. So it didn't impact them at all. There's some extra reporting that goes along with it, where you can get a bigger bump as if you've got more normal rents and agree to keep 20%. And that's Fannie's tool of their lever they can use to get more affordable rents in high rented properties.
So I'm going to do a little role play. I'm going to pretend I'm a borrower who shows up to each of your offices with a portfolio. And clearly I went to Rochester, John Marshall, like Jeff Johnson, because I have not refinanced. And this is news to me that I should be refinancing because rates are low. So if you have that conversation with one of your clients, what are you saying today? Because I'm honestly, I might say, well, I might wait for better proceeds down the line if I want more cash out, but boy, the rates sound really good. So maybe let's go this direction all the way down. Start with Dan. How would you have that conversation with the client today?
Well, I've been in the business for about 20 years. I keep saying rates are going up and I've been wrong for 20 years, but I'm going to stick with it. So I think everybody should refinance now. Yeah, I mean, it's, you kind of pull out the crystal ball and say, where do I think rates are going to be in a couple of years? And in the meantime, you're watching your rents climb, and as long as they're climbing more than your expenses, you're creating value, right? So can I sit on it for a little while and wait and you make a lot of assumptions with that, right? But it feels like a pretty good time to be in the market looking for debt right now. And there's kind of two components to the debt, right? It's the treasury and then it's whatever the spread is, and both are pretty favorable right now. And so the underwriting is aggressive, the rates are low, the spreads are low, and the fundamentals of everybody's properties everybody's properties are doing pretty well for the most part. And so, I feel like it's a good time. There's certain constraints if you're really trying to cash out and you just built the property and it's only been open a year and you're trying to get 120% of your cost in the deal, and lenders will pull back on that. So you may have to wait a little bit to kind of let that ride itself out. But I guess, by and large, I think it's a pretty good time to at least kick the tires on doing the refi.
Yeah, obviously very similar. I mean, when we're talking the HUD products, we are talking long-term, really good fit if you're a long-term hold. The loans are assumable, and we're seeing more assumptions through what HUD calls the transfer of physical assets process. Because the low rates, I think, are attractive to buyers, but we're really pushing the long-term nature of it, 35 years at 80% leverage for cash out, and obviously the rates we talked about, 225 or below. So that's really the main push and selling point there. There is some flexibility on some items there as well, especially if we can get the green MIP if you're a newly constructed project. So we're seeing with that 223F elimination of the 3-year rule I mentioned, we're seeing a lot more newly constructed projects, and we're hearing a lot more people coming to us and I think HUD lenders generally to look at potential takeouts of bank loans. So we're trying to get more in front of those types of products than we have in the past, with that being an option too.
I'm going to challenge you quick though. If I'm the borrower, I might say, I might be long-term, but it might not be long-term. And I got to know about this assumption thing, because as I'm thinking through the finance of this, maybe having this really low interest rate is a benefit to me 10 years from now. How difficult are the assumptions? What are the challenges there?
The assumptions are not difficult other than the time it takes. It does take about 3 to 4 months for HUD to process that request. But if you're selling to a qualified owner, I don't think we've seen one turned down by any means. So it's just a matter of getting ahead of it and getting the documents submitted early. I think the biggest thing is if depending on how much that loan is amortized, because HUD doesn't allow supplementals, then sometimes the acquisition would be at a much lower, LTV if there's value appreciation. But with those low rates, we've been seeing a lot of interest in assumptions. And I think our servicing department's been a lot more busy on that than they have in years past.
Then do they allow financing on top? I'm picturing 10 years from now and the proceeds are low because rents have gone through the roof. I don't know. But can I get debt on top of that? Or am I constantly restricted to the one loan, the one HUD?
HUD doesn't have a supplemental, and unfortunately, they don't generally allow you to add debt after the fact. There is a program within HUD it's the 223A7 refinance where you can it's a streamlined program where you can lower the interest rate on your existing HUD mortgage. There are also options to do a rate reduction modification. And we're doing a lot of both of those programs right now. The modification is essentially a rate reset where you keep the existing balance and you keep your existing term, but we sell a new Ginnie Mae. And so your prepayment penalty restarts, but you can reduce your interest rate with keeping everything else equal. So there are some options there as well, not necessarily to increase the debt significantly or take cash out, but there are some options as you get further along in your term.
Well, let's get back on track here. Lucas, how would you have the conversation with somebody about a refinance today?
I'd kind of echo all the same stuff that these rates in the 2s and low 3s, at some point you got to take some risk off the table. And I think we've all used the line like Dan said, but if you can't make your deal work at a 3% rate, it's probably not the right deal. And it's very attractive right now to be a borrower. The one thing you would want to watch out for is what your long-term plan is, because agencies have the 10 years of prepayment penalty. HUD, well, it's locked for 35 years. Your penalty goes away after 10. So you're not, that's a nice perk of that. But it's just managing that prepayment penalty. I've had a handful of borrowers that we've done deals 5-6 years ago with agencies or life insurance companies that have yield maintenance now and are trapped a little bit just because the penalties are too high that they want to sell or refinance and at that time it was a 4% rate.
Well, the rates keep going down. So the yield maintenance gets worse, right?
Yes.
Why did we agree to this
Yep.
5 years ago? Because somebody sat up here and said rates are never going any lower. And so I pulled the trigger and then they went down.
I've had that same conversation. And, like Dan said, we've been doing this forever. I've never sat on a panel or watched a panel where people said rates are going to go up or rates are going to continue to go down. Everything we've thought we've been at the bottom for 15 years now.
So one of these last two guys has got to tell me that rates are rising, knucklehead. Let's hear it. No? Well, let's just keep moving down the line. Go ahead. What would your speech be for refinance now?
I mean, typically my guidance is if the deal works now, pull the trigger. Nobody knows what it's going to be 12 months down the line or longer. Depending on your game plan, Fannie and Freddie both have supplemental options. So if you do see a big value creation coming down the line, you can pull some of that out later on, and it's not punitive by any means. Yeah, HUD's probably a cash out king.
Well,
And
Brock,
80% loan to
oh, I'm
value.
sorry, keep talking. I thought you were done.
All good.
I would to add on to what Wilson's saying is if you're comfortable now with the rate, I'd move. These treasuries just keep bouncing up and down, and I think we're up 15 or 20 basis points from last week. And we're gonna go back down 20 basis points. We're gonna go up 30. It just, you're throwing a dart here. But if you're comfortable in that range, now is the time to do it before they really run up.
Brock, I'm going to give you an out since I made you wait till the end and probably everybody said everything you wanted to say. Let's change the tone just a little bit to I'm considering selling versus cash out refi. And where would you counsel somebody today on that decision?
You know, it really depends, right? If, you know, if you're worried about taxes, right? And, you know, some owners are just more like to hold forever. But, you know, I think, you know, the nice thing about a cash out refinance is that it's essentially tax deferred, right? So you can pull a lot of cash out at these historically low interest rates. And you know, essentially invest that back into your property or use that as equity for another investment or development.
The developer famously once said, a dollar borrowed is a dollar earned. Would you agree with that premise? The lenders are like, no, don't say that.
Well, what I would say is debt is much cheaper than equity. So, you know, if you're working on new development and you have to pay your investors an 8% to 10% preferred return, but you can, you know, pull out, you know, 90% of your basis, or even in some cases over 100% of your basis at, you know, sub 3%, you know, math's pretty simple.
You look like you wanted to add something, Dan.
No, well, I mean, you know, with cap rates at 4%, you're almost effectively selling it, but you get to keep it if you take all the cash out, right? So, you know, obviously people have different motivations and different business plans and all that, but you know, if you're okay holding something forever, then you can extract all your equity back out and you've effectively sold it, but you still have it, right? And then if you sell it, you've got to figure out what to do with the money, which is the biggest challenge, I'm guessing, for everybody in the room here. Where else do you put it?
That's a tough question. When you answer that, you could manage money for most of us. What's that?
Different panel.
Yeah, right. Well, we'll figure that out. Jeff Johnson, if he's not in the room, he'll think of a panel for just about any topic. Okay, well, you know, that last panel didn't at all want to talk politics, and you all seem to be at least okay talking about the effects of one of the hot potatoes right now is rent control. How, at least, we don't have to talk about whether it's good or bad or whether it's going to be helpful to the market or hurtful to the market, but certainly it's on owners' minds and developers' minds and lenders' minds. So especially those of you that can see this from a regional or national scale and look at Minneapolis and St. Paul, how are your lenders and lending sources viewing those possibilities, and how are your borrowers reacting to that?
I would just say it's maybe a little bit early to tell, just because the way everything's worded right now, there's a lot of unknowns. But I think what's kind of interesting, if you look at markets across the country that have rent control, and two in particular, New York City and San Francisco, they have some of the highest real estate values pretty much in the entire world. So, you know, I can't predict what's going to happen, but, you know, what does that say? How that could affect values in Minneapolis and St. Paul?
I guess I'll reiterate, we'll wait and see.
Just a lot of the stuff that we do, it's all backwards looking, rents and collections and who's paying and who isn't. So we're not underwriting a forward 3% bump every year. That it would come in more to play with the banks and the debt funds and those sorts of lenders.
I was going to say the same. I mean, when we're looking at a construction project as well, I mean, on the HUD side, we're looking at today's rents not being trended. So potential rent control wouldn't necessarily affect that underwriting. Now, you know, Minneapolis does have the inclusionary zoning, the 10% affordability requirement. You know, what we heard initially, you know, some developers pulling out of Minneapolis or slowing down. We're seeing a lot of projects in Minneapolis. So I don't know that has killed development. It does make numbers a little bit harder to pencil out when you've got rising construction costs and mandates that aren't necessarily being paid for in other ways. Typically, you would expect some TIF or something in exchange for required affordability provisions. But, I don't think that that has caused a significant slowdown in Minneapolis. So it's kind of hard to say what rent control would do from that standpoint.
I don't know, I have a lot to add to that. As Lucas said, I mean, our lenders tend to be a little backwards looking, maybe when they're projecting exit tests, because Fannie and Freddie have exit tests, and it's kind of a mystery algorithm that goes into that. But I think generally the rent control piece is being limited to something on an annual basis that's in line with, or, probably even a little higher than what most lenders would use for annual increases in rents. So I don't think it'll impact that. I would, though, encourage everyone. I know the Multifamily Housing Association's got a big push right now to get people educated on this, because I'll be the first to admit I'm a little bit ignorant when it comes to all the nuances and the possible positive and negative effects to rent control. And they're putting out a big program now to get people educated, which I think is it's certainly going to impact everyone in this room in all likelihood. So I would suggest getting smarter. I'm going to plug for that. I'm not smart enough to know. So yeah, but in general, it's always a good thing too.
Well, so then let's just talk about, maybe let's just do with some of the same questions we did on the earlier panel, a little bit easier questions, but get your opinion on them. We talked on the first panel about unit size, unit mix, those types of things. What are you seeing from lenders in terms of preferences? I looked at a project, a historic conversion, and the unit size worked out to be like 560 to 580 square feet, just the way the floor plan's laid out. And this was maybe 10 years ago, 7-8 years ago, somewhere in that range. And everybody thought it was nuts. Like, there's no way, those are micro units. And now you see, the 400 square foot unit thing where you're living in potentially a shoebox. But with affordability issues, those are important units to be able to deliver to the market. So what are you all seeing in terms of unit mix, large units versus small units? I'm just leave it open to whoever wants to jump in first.
Well, I think prior to the pandemic, we were certainly seeing a shift to smaller units, and we have a couple projects that just recently finished construction, leased up, and when we were underwriting them a couple of years ago, we all thought, well, the studios and the micros and the alcoves would go first, and the penthouses and the large twos would be the ones that still have to be leased. And we're seeing the opposite as they're opening the big units, the penthouses, the twos are the ones leased first, with the small units still out there on the market. Now they're leasing up, but I think that speaks a little bit to, work from home, and, the alcove and the micro unit works great if you're in your unit a couple hours a day, but if you're in your unit 24 hours a day and trying to work from there, I think that gets a little small. We are still seeing that, from an affordability perspective, because I think developers are looking at chunk rents and what people are able to pay. But on newer projects, and especially in suburban areas, we are seeing more pro formas include 1+ dens, maybe some larger floor plans as well, reflecting and designs reflecting people spending more time in their homes and less time in the office. So I think it's been an interesting shift. I don't know that we have, or we're going to completely shift away from the small units, because those are more affordable from a rent per month standpoint. But we're seeing developers in other parts of the country too build in built-in desks and really try to incorporate workstations within the plans of their individual units.
Yeah, I would say there's probably a little bit of tilt to go, average unit size are probably creeping up, but it's really dependent on the location. We're selling a property right now that's been in lease up, but it's a more urban location, has smaller units, and it's, they've frankly been stealing tenants away from the competing properties in that neighborhood that have larger units. But conversely, we're, selling property in, a more suburban location, and there's definitely more demand for the larger units there. So it really just depends on where you're located. And I think that's what the lenders are looking at too.
What does Denver look like, just out of curiosity, compared to Minneapolis on the unit mix?
They were definitely trending smaller units there, and it's similar. I think on average, they, properties that have smaller units, their costs are higher there. They have, higher impact fees. Pre-pandemic COVID, it was mid 300s a unit to build a property in an urban location, and pushing into high 200,000s, low 300s to build something in a suburban location. So it was just trying to, manage costs and, also just looking at those chunk rates too, because that market has gotten very expensive. I financed a property in that market where they were getting $4 a square foot on 1,300 square foot units. And we valued that property for over $1 million a square foot, $1 million a unit. And, some people maybe have seen an article recently, there was a trade, JLL actually sold the property. It was right behind Union Station, and that property traded for over $1 million a unit. And they were renting the penthouse there for $20,000 a month.
What? I gotta think you could buy a house, just saying. Any other comments?
I guess anecdotally, I don't necessarily feel either Fannie or Freddie have an explicit desire or motivation to either get into or away from unit sizes. They did kind of lighten some restrictions on concentrations of micro units as they define them in properties.
Okay.
So those deals are kind of back on the board now. But and they're both comfortable with modular housing. Actually, Greystone signed up a LIHTC shipping crate project out in LA County. So
Cool.
kind of an interesting one.
That's a fixed size, by the way. That's not a big unit.
Right.
I'm just guessing. Living in a shipping crate would feel a little cramped.
Yeah,
But
definitely market dependent there.
Mike brought up a point about dens. I can foresee a time when you say 1 bedroom plus den, and the den is 3 feet by 4 feet, and you'd say, I'm pretty sure that's a closet, but can't tell. Is that something you're seeing at all or not? They're still pretty normal size.
I haven't seen that. I mean, I think they're fairly normal sized, maybe a little bit smaller. I mean, in the age restricted properties, like Patty mentioned in the first panel, those dens are very large because those are people who are maybe downsizing and still can't give up that second guest bedroom, and that's what they use it for. But 3 feet by 4 feet is a little small.
If Harry Potter can live in it, right? We get the Harry Potter generations growing up. I think I got nieces who, just watched that whole series, and now they're they're in college or moving into their first apartment. They'll move under the stairs, I guess. I don't know. All right, well, let's shift a little bit because nobody brought up the 3-bedroom thing, and that's how I transitioned on the last panel. But I think we're lacking a type of housing here for that, family, the growing family, people that need a little bit more space. So how are your lenders looking at alternative product types like single family build to rent or communities, or townhome built to rent communities? We can start this end and go that way this end.
Yeah, so, nationally and locally here, we're active on placing loans on, we're supposed to call it build to rent product for Freddie Mac. But yeah, we actually did just refinance one. Some people in this room might be aware of Beacon Ridge was a project that delivered the end of last year. Had a very successful lease up. We took that out to the market, a few months ago. And, we went out to both primary life insurance companies and the agencies. A lot of interest in that product type, but I will tell you, for the life insurance companies, most of them passed. It's a new product type for them. They just don't quite understand yet. I think for them, as far as the repayment goes, they're really just looking to the property. And, if for some reason they had to foreclose and operate the property, they don't really understand yet what the expenses are. I think that's the biggest challenge overall, is there's not many of these that have been built and stabilized. And so it's very hard to comp what the expenses are going to be. So that deal we ended up doing with Freddie Mac, and our competitors on that were Freddie and Fannie. And we had a couple life insurance companies that were interested, but at very low leverage.
How low?
They were more of like, 50%.
Pretty hard to get a deal done today. If you're a borrower and you're thinking.
For that
way.
particular deal at that leverage, it wasn't gonna refinance them out of their existing loan.
Okay, moving on down. So build to rent, single family or townhomes.
At least on the townhome side of things, we've looked at a handful of HUD D4 construction projects like that, and they seem to finance quite well. Just given the underwriting constraints that HUD uses there.
Now, this would bring in a lot of smaller developers though, right? This type of product. So you could build, you don't have to build a 200 unit apartment building. You could build 4 townhomes or 6 or 8 or 20. Where's the low end for financeability?
At least on what we're seeing in it's still, 80 plus units.
Okay.
And really dependent on market and what your costs are there, but it works. And I guess just anecdotally talking to some of the affordable borrowers in our space, at least in our market, bigger units are in demand as families are priced out of single family housing. And they need to move into a larger affordable unit, something 3-bedroom plus.
So would
Work
you,
those in.
and when you say affordable, you mean you're actually marking that as affordable and saying.
Yeah, deed restricted,
restricted.
affordable,
Okay.
like tech stuff.
Right.
When you talk about size, a year ago, I did a 12-unit townhome, and the units were really big. And those were all 3 bedrooms, and rents were a couple $1,000 a month. So I think it was an acquisition, and it traded around 200,000 a unit. So it was a smaller loan. Fannie Mae did that.
That's encouraging. That's a market that we're missing, right? And frankly, us as real estate journals, sometimes we forget to talk about the budding developer or smaller projects. It's good to know.
HUD works really well, I think, on townhome development. I mean, we're seeing developments that have, 6 to 8 to 12 units per building, attached garage on the first floor and unit above and larger units, and that works well. HUD did announce, however, that they don't want to, they're right now out of the single family rental market. You have to have at least 4 units in 50% of the buildings in your project. I think similar to what Brock said, it's concerns about how you figure out expenses and reserves on that type of unit. And given their volume, I think, personal opinion, I don't think want to dig into it at this time. I think it's something that the lenders and the industry are going to continue to push on, but right now you have to have at least 4 units in 50% of your buildings.
Yeah, I don't know that I have much to add there other than, these just for clarity's sake, these aren't like scattered home sites, right? These are purpose-built
Right.
rental communities where it was planned. There's more than likely some kind of central, whatever, common area surrounded by a bunch of single family homes. And yeah, we've seen it a lot more down in the Southwest. Our Arizona office has done a lot of that business and sold a handful of those deals too. And primarily financed by the agencies because they're the ones so far they're being the most aggressive, as it's, gotten more of a national platform and people are doing them in other markets, including here. I think you'll see it more and more. And I think lenders will become more comfortable once it's, they're better able to quantify the expense differential.
How long is that going to take? Because this market desperately needs that type of product, given the home builders aren't building entry-level homes. Where are these people going to go?
I don't know. The agencies are pretty good and they're swinging pretty hard. So I don't know that there's a shortage of takeout capital for it. It's maybe not, if you're okay with an agency platform, if you're looking for a 30-year fixed rate deal on your takeout, then, maybe that's going to take a little while, but I think there's enough capital here to support the construction of it, right?
Well, we're running low on time, so go ahead, Brock.
I would just
Finish it.
add on the rental communities that, as far as agencies and a life co, if they were to look at it, the one thing is they want it to be a community, right? That's branded as that community that has amenities specific to that community. So it's really challenging if you have a home developer that builds whatever 200 homes and then they're trying to carve out 30 homes as a rental community and to say that's our rental piece. They really want the rental community to be its own branded community with its own separate amenities.
That makes sense. Well, that'll be fun to see that play out. I didn't mean to interrupt you. But I had full transparency here. A lot of the acronyms went over my head. So when I took notes, I thought I was pretty thorough, but I'm willing to bet I missed something. So before we go to questions, did we miss anything that you all wanted to talk about? Feel free to just jump in. If the answer is no, that's fine. I'm going to take that as a win for me. But
Yeah, no, I think you did a great job. Don't beat yourself up. But I would just mention, just because we've done a few this year, is manufactured housing communities are certainly seen a lot more headlines of those types of properties being purchased here, and a lot of times by more national groups. But that's become a property type that's, I don't know, getting more and more bandwidth, and the agencies are swinging pretty hard at that, given the affordability that's generally inherent to those types of deals. In our market, it's more agencies and banks, credit unions that'll go after that product type, and down through the south where it's more retirement type manufactured housing. That's, that life companies do get interested in that product type, but that's, I don't know, it's becoming, you see a lot of headlines. It's becoming a bigger part of our business. So
interesting.
throw that
I have a
out there.
feeling you're going to see some blurring of the lines too. I have a friend who's a small developer that's building a house, but it's modular. So they're shipping it in. That's a manufactured home, right? Isn't it? And if you built 5 of them, it's a manufactured home community, or is it just a construction method you built for single family home built for rentals? Where do you draw the line?
Well, you're going to see that more and more just in the apartment space in general. Right? I mean, there's some nuances with who, how do you protect the collateral when it's in transit, who owns it at which point in transit is they're figuring that out, and I think generally haven't figured out, but that's, again, you see a lot of headlines on that. I think there's a number of projects around town that get built that way.
But I think if you're comfortable in the manufactured home side, that'd be the far end of it. Then you could get comfortable with the stuff where the lines get blurred. Okay, let's open it up for questions. Anybody in the room or anybody online? Let me get the chat room up here. Buttons, pushing buttons is hard. Where did my chat room button go? Jay, you got one? Okay, go ahead, right in the front.
Climate change. Somebody was mentioning earlier that snowbirds moving to the southwest, for instance. How is climate change? But that's the fact that reservoirs are not anywhere near full, and that's going to take years to fill up again, and they're going to be under water restrictions and other restrictions. How is that going to affect?
Dan kind of covered this in our prep call.
It all began a long time ago. Yeah, I'm definitely not smart enough to answer that one, but
Maybe just repeat
I
the
can
question
speak,
or
though.
summarize it before you answer. Whatever.
What's that?
Just summarize the question for the
sure.
people online.
Yeah, I mean, how is climate change going to impact things going forward, particularly as it relates to the Southwest, where water levels are super low? I'm kind of speculating. I guess I don't know the answer. We're somewhat fortunate here, or very fortunate here, I guess, depending on how you look at it. But certainly, I would imagine, and I know just working on some deals in the Southwest, and Brock, I'm sure you've got more experience with this, where people have water rights, or do they? And it's becoming a bigger and bigger deal as new projects get proposed. What ultimately happens there, I don't know. We didn't cover that in the call.
Yeah, I mean, I think we're already seeing an impact of it just in expenses, particularly in insurance, especially in kind of markets that have been impacted by hurricanes, which we're seeing a lot recently. And so, we're seeing more, strict insurance requirements, I'd say, in particular from the life insurance companies. In some instances, they want, 100% of the actual value of the building instead of the insurable value.
Yes, in addition, all the agencies have incentives for building or operating your property to a green standard to try to reduce use of resources as much as possible.
We did talk on the first panel a little bit about pace, but the point behind that program is reduced energy as well, right?
I think at the end, if your expenses are going to go up, the rents are going to go up. So owners aren't going to bear all of that cost. They're going to pass it right on to the tenants, and rents are going to come up. People aren't going to operate apartment buildings and not make any money doing it.
And with the green MIP incentive, I mean, we've seen almost every market rate development that's been built using HUD financing, built to LEED or National Green Building or one of the other third-party green standards. You know, the reduced MIP almost pays for itself, but we're seeing more energy efficient development as a result.
Last chance. This is our last finance panel because we're going to move into technology. So this is, if you had a burning question, this is it, online people. Otherwise, we're taking a break. All right. Well, let's say thank you to all of these folks. Wonderful panel, everybody. Appreciate the information. We'll see if we come back a year from now, what happens with interest rates.
$100.
We recorded. Oh, yeah. Yeah. And you'll bring back 101.
Yeah.
Hey, thanks for work.
We're right.
This is your 2-minute warning, 2 minutes. If you were at a hockey game, you'd all repeat that back to me. 2 minutes. Haven't. I know, right? It's just the 3 of us. We'll get by just fine. Yeah. Well, his picture looks great. We can make fun of him when he's not here.
Workout.
I wouldn't do that.
Ask me to be a little more.
Next time that would be you guys. We got a couple minutes here, but yeah. Let's. Everybody online's hearing this conversation. Just perfect. Just so you're aware. Uh-oh. I'm gonna mute those 2 on the end. No, you're good on those.
Actually, we'll grab a glass for water.
Having 5 wireless mics, they're always on the verge of like interfering with each other. Somebody's cell phone, somebody leans in too much and their cell phone gets in it. Of course. I've learned way too much about AV in the last 18 months. The hardest part for us was when we first did our first hybrid event. We were like, well, you just plug the camera into the computer, into the Zoom, and then you plug into the PA system and you're good, right? Well, it turns out that creates all kinds of infinite loops. And then I didn't know this at all, but the video camera, which is just like a camcorder, right? But it goes out to an HDMI. Well, the HDMI in your laptop is an output. It's not an input. So there, you have to buy this device that reverses it or whatever, and it goes into your USB. Well, they were, like things like that weren't, they didn't manufacture a ton of it. Right? Yeah. So then all of a sudden everybody's buying that. And so that took a while to figure out. But now the good thing is now you can get a video capture card for $20. They were $200 at the start of the pandemic.
That's everything's crazy.
Yeah, right.
Next to nothing
Now, right.
Yeah, before I had to pick one up for
my nephew's wedding.
Yeah.
This past year, and I'm like,
Yeah.
60 bucks. Wow, I would have expected 350 bucks for
Right.
what I would have had to get.
Right. It goes crazy. My son's just his like his computer. He put together a custom computer. He was telling me like pricing. I was like, that's what I'm paying for. I was like, yeah, I could sell my computer right now, Dad, and I could like triple it the cost.
That's crazy.
We're like, it's nuts.
I built my own at the beginning of the pandemic too, so that we could run events out of my house without having any issues. It was like, I got $3,500 on it.
Really?
It can't get expensive.
I thought the pandemic was gonna at first was gonna really slow us down.
Yeah.
We would.
We've been busier than ever.
Yeah, most bizarre thing that ever happened in the pandemic, toilet paper, number one, what the hell? But then since then, it's been a series of completely unforeseen, bizarre ramifications.
Well,
You couldn't buy a pickup truck for like 45 days?
Yeah.
Right.
What the hell?
It's crazy just watching the differences between cities. We were just in Boston. Me and the missus here this past week, and it seems like they're like 3 months behind us. Like in terms like they're still working through their mask mandates.
Sure.
And I mean, they were very serious about masking, which I kind of understand. It's obviously a bigger metropolitan area, but
Yeah, I think that, and I've been saying this for a while now, that your feeling on COVID has to do with your personal experience with it. And so now I've
Absolutely.
had a friend who's had close to him death, who before was like an anti-masker, who cares about vaccines, let's just get rock and rolling. And I was like, wait a minute. Once it's taken out somebody you know, it changes everything.
oh, it gets real. Yeah, same
So
thing.
if you live in a dense city, you're probably more likely to know
Yeah.
somebody that's lost their life or got ridiculous.
I mean, it was we had a great time. Everything was open, but yeah, I just found it interesting. I was like, here, it's like there's almost not even feels like a mask meeting anymore because it really isn't. You know?
Let's get rolling again. We're going to shift gears here. This is new for this year to start to talk to this group about technology, but we, the Real Estate Journal, REJournals, are making a big push company-wide to help people understand technology, especially in multifamily environment, and pick up that topic and run with it. So hopefully you enjoy this. While everybody's sort of milling about and sitting down, we were having a great conversation up here that I just want to continue. So anybody in the audience is free to also answer this question, but what is the most bizarre thing that the pandemic has caused that you're aware of? And I'm going to start with two things. I might steal somebody's thunder, but toilet paper. Why in the world at the beginning of this pandemic do we have a toilet paper shortage? The virus has nothing to do with that part of your body. And the second thing was then like after toilet paper, like 2 months later, you couldn't buy a pickup truck. Who wrote the playbook for COVID, by the way? I mean, it makes no sense, but feel free to jump in. What was the most bizarre thing that you've seen ramification from COVID?
Yeah, just a second off your toilet paper comment. The fear is still real, even if, even if that's not affecting that part of the body. But for us, was business wise, it was just really interesting to see the dynamic of where where COVID took us. I think for the first couple months, it was like, all right, how are we going to navigate this ship? And for my group, now we only got busier, so it was not fun navigating it personally, but professionally,
But bring the
take six
microphone in a
COVIDs.
little closer too, so that, online people can hear you.
Ours is the same issue too. We're busy as heck, but now we have to order product 6 weeks earlier than we normally would because we can't get product. The work is all there. It's just the product and the manufacturing can't keep up.
Yeah, like lumber. How do we have a lumber shortage? If you would have said 18 months ago, COVID's going to cause a lumber shortage, we would have all put you in the
Yep.
loony bin.
Yep.
Okay, so thank you for paying attention. Thanks for humoring me. Now that we got everybody to kind of quiet down, let's do introductions again. For those of you who just tuned in online or just showed up, I'm Todd Phillips. I'm our CFO at REJournals. So I do moderating panels is my night job. During the pandemic, I had the pleasure of running our company from my basement. So I've done a lot of these panels. I think I did over 100 during that time frame, but I've had like 6 months off. So I'm a little rusty, but catching up fast. I did bring my Diet Mountain Dew that I would normally have at my desk at 6 a.m. So I just recreated my COVID work style here at the podium. And hopefully we just flow like that. So let's do, Sean and Jake are up here. We're missing one panelist, but that's okay because we got it covered. Just introduce yourself real quick, what your company does. We talked a little bit about COVID, but maybe, you know, how your company's been affected recently or what your work is like now in that environment.
Sean Chambers with Focus Systems. My division of the company is commercial-based, multifamily, low voltage audio video technology. If it's low voltage in the building, we're on it. Access control, camera systems, amenity spaces. As far as how it's been, I expected it to slow down when everything hit, but it seems like multifamily is just still booming.
So do you work on just new construction or?
Nope, both. We'll do new construction, and that seems to be really hot right now.
Yeah.
But I think once that tapers off, then all of the existing buildings will be playing catch up with amenities and upgrades and things. But we also do those.
Okay, so Jake, quick intro.
Jake Henninger, with Arvig. Arvig started out in the 50s as a small telecom provider. They've kind of morphed themselves into one of the largest independent telecommunication providers in the nation. So their business has multiple different facets, everything from they're the incumbent internet service provider up in the Perm area. And as you go further down south, we run most of the fiber business. So business team does everything from selling to cell phone networks for 5G services to businesses. And then there's my division, Multi-Wave, where we primarily focus in the multifamily space. So just like other internet service providers, we are a fantastic addition to apartment, condo, townhome communities. And we bring our fiber in at no cost to ownership manager groups. So really allows them to be a bit more competitive and bring a new provider into the space.
So we'll talk other property types too. And there's a couple dynamics going on here. One, we live in a world where this video is going to go on YouTube and office and industrial people can learn about technology too. But we're going to focus. So I want to focus most of the time on multifamily, but I think in your conversations, you can feel free to talk about other types of real estate. And some of the people we have in the room work for companies that have all different property types. So we'll do a little bit of both and kind of work through it that way. There we go. I got to find my notes. Panel 3, there we are. Okay, so on our panel call, and I threatened earlier to record panel calls, and we should have probably done the same thing, right? We had some good conversations. But we talked about property managers, and they're the ones now saying, I need this technology to properly run my building. So let's talk about the property managers, what their needs are, what kind of technology they're running, and then how you're sort of helping them have that ability to make that happen.
Sure. It definitely is a driving force right now. It's only helping lease the properties out. I just had a meeting last week with a developer and the property and the management company that will be managing the company or the building, and the ownership kept looking to the management company going, okay, what do you need? And then looking to me saying, okay, whatever's going to make this company succeed to make people lease it in, which is, they want the fiber in, they want to be able to, whether it's being utilized or not, they want to be able to say fiber is run to every unit. Your internet is up to a gig. Amenity spaces have all the bells and whistles. It's a competitive area right now.
Right. So the property manager is saying, owner,
need
Mr.
that.
Owner, you have to fiber my
Yep.
building. Okay.
Yep.
Well, and we're going to build
Absolutely.
on that as we go through.
I think just technology in general, you have right now a very unique time where data consumption for everyone here raises about 50% year over year. So data is going to just continue to be one of these things, as you know, people are going to need to stay connected. And I think when you look at it in the multifamily space, you're looking at it from a perspective of how do I keep people connected? And, you know, there's traditional ways that this is done, you know, providing free Wi-Fi services. You know, I think that's kind of the old fashioned way. And I think with the more educated consumer now, they're looking for, you know, this is my home. How can I stay connected? And what is this property going to provide me to be able to do so? And so I think you see things like, you know, a lot of smart home tech, things inside the unit. I think from a property perspective, it's how do we make this this property you know, more technology driven with keyless systems,
Right.
You know, key fob systems, things of that nature. So, you know, I think when it comes to the technology, the actual product side of it, you know, they're certainly looking for things that they can update there. I think from a infrastructure perspective as well too. I think a lot of people are uneducated on, you know, what exactly is out there. I think, unfortunately, in the internet industry, the internet service provider industry, you know, I think people have gotten used to the way the system is with asymmetrical speeds. Really, you know, they may be able to offer a high download speed, but a very slow upload speed. And I think with new technologies like fiber and the ability to be able to get it into those buildings and start powering some of these systems, you know, fiber offers symmetrical speeds. It does some things that are going to be able to power the technology a little bit better that we had alluded to. So,
Well, and on
Yeah.
your speeds, talking about how the infrastructure needs to be able to support everything. Actually, I had in this conversation last week with a developer, it's a big deal, like talking about TV service to the building. What are we offering in the units? And the conversation, you know, okay, yeah, that's great. You have your DirecTVs, your Comcast, whatever for television, but 50% of the people in the building aren't using a television provider. They're using streaming services, which are now dependent on fiber and the speeds that are available. So TV services are kind of going by the wayside as a la carte. Maybe they'll be used. It's all going towards, I have 6 different streaming services and that's all I watch my stuff on. And if the internet sucks in the building, it's a big deal.
I feel like it flipped a switch because
Yeah.
I think if I would have built an apartment building 5 years ago, it would have been placement of the flat screen TVs and how many you could have. I saw a listing on Zillow the other day with like, it had like 40 TVs in the house. Let's do a little audience participation. I'm down to 1 TV. How many people are down to just 1 TV in your house? How many people still have lots of TVs? Yeah, I think you all are just showed your age, like me. Like
I have 3.
if you look at my kids, they haven't turned on my TV and I don't know how long. And they've got all kinds of devices that they watch all kinds of things on, and none of which are the TV. I mean, and I probably would, if I could see my device with better glasses, I probably wouldn't even have a TV either.
And that's what we were discussing at that meeting was the demographic difference too. Now, okay, what half of this building, it's the broad range of age groups, but the mid to late 40s plus still kind of want their DirecTV and everything, but everybody else below that, it's not even on their radar.
yeah, I think what you're at least willing to see in the market. We talked a little bit about 55 plus a little earlier today, and you know, you talk about some of those communities. I really find that they just want to be educated more than anything, and I think that, you know, gone are the days of this technology as this big scary thing, right? Like, oh, I'm not touching that Roku. What does that stand for? You know, now people are willing to go, okay, hey, how does this work? And they really are willing to listen. I think a lot of the 55 plus communities that we have provided service to, you know, when we got to that discussion on, hey, we've traditionally done this, you know, what is your solve for that? It was really more about educating them on how to use it, what to use, what not to use, the different options that are out there. And once you bring it down to that level, I thought that they were very open to, to listening and to learning, really.
Right.
So I think we're starting to build out this idea of the needs, the user needs, and we've seen the transition from a cable, need of a cable or multiple to have multiple flat screens, switch over to the devices, and that's the consumer inside the unit. But in a building, a multifamily apartment building, or even an office or industrial building, there's more uses now than just those devices, right? So what are some of those things that have come alive in the last few years and maybe foreseen in the future, we're going to be more need necessary? But I'm thinking security systems, entry systems, management systems.
Yeah, I
payment
saw
systems.
a community, I forget the company that did this, and it might have been In Focus that did.
Let's say
So
it was.
shameless plug.
We'll say it was.
But it was very unique. They had an upstairs rooftop deck. And one of the things that they had done was they had taken their TVs and allowed for a panel that they could hook into. And the example that they used when I asked, well, why would you hook up this panel that people could plug into and use these TVs? It's like we utilize it for fantasy football drafts. And I thought that was such a really neat idea, that they not only took the technology of their building, right, and now they're opening it up and offering it to their tenants and really giving them the experience of having that technology in there. That was one of the things I've run across that I thought was really, really neat. But I think when it comes to products, it's really endless in terms of what's out on the market. You see a problem for it, they're going to probably make a product that can run off Wi-Fi to fix it.
Right.
So,
Yep. And that probably was us, because we started doing that in club rooms and amenity spaces, because otherwise people were unplugging things on the back of the TVs and
Oh, sure.
screwing up the system. So you give them an actual location to plug their stuff in, then they don't have to touch anything. It's now part of the system. But yeah, that type of stuff, making the amenity space feel like it's at their disposal. It's their area to use. And then the smart units are still hot right now. And by smart units and smart locks and giving the resident the ability to get through the entire building using their phone as their fob, to get in the front door, to get in the amenity spaces, to get in their unit, to allow guest access for, I have a dog walker on Wednesdays and I'm giving them a virtual key that's only good for a couple hours a day at that window of opportunity.
So if my building still has a fob that is on my keychain, which is also a dinosaur and dating all of us if we have keychains, but I see you've got a boat keychain that you got from Bridgewater. Bridgewater's got great.
They didn't have stress balls, so.
I forget for CE reasons, we can't promote anything, so just hide your. So, but the keychain thing is kind of gone too. And so now I've got a smartphone. So just walk me through, if I'm a building owner, what upgrades do I need and what can my tenant do with their smartphone, or me as a landlord? Can I also use my smartphone to control access?
Any number of things. He's not on today, but Cyrus with Butterfly, who was going to be here, their entry system is meant for guest entry. As you come into the vestibule, it's for the residents to allow guests to come visit them. When I walk up to call you to let me in, that will do a FaceTime call with your phone, so you can see who's down there before I know that you can see me. We can interact. You can decide to let me in. That being said, with that, and then the access control system for the amenity space, you'll be still in one app to get through the whole amenity space and up to the units. And depending on what they put in the units, if you have, there's a couple other companies out there that do reasonably priced retrofitting technology that we use for the units to give you lighting control, thermostats, music, whatever you want to control in your unit, and you'll have remote access too for that.
So if I forgot to turn the lights off, I can do
You
that.
can check the status of them and adjust them and change them.
You mentioned dog walkers,
Yep.
I think, in our prep call. So,
Yep, dog walker.
Would be wonderful to have someone come and walk my dogs if anybody. But if you were so lucky,
Right.
You
Or if,
could program it to let them in at a certain time,
You
turn
could
the
do
lights
that.
on.
yep, you could do that. They would get, it essentially would send them a text message with a QR code that you can get through the building and into your unit where you need to be. You know, you're out of town, somebody's checking on the house, you give them access for a week's time or something. It can be dialed down to whatever you want, time-wise and date.
So to make all of that run, this is without, at the risk of sounding like a sales pitch, now you need that connectivity, right?
Yeah.
Yep.
Well, I think you need the connectivity and you just need the right technology to run that, right? We talked about access points and different things that traditional communities have done. Give me 1 second, we'll go right over to him, but
Yep, for sure.
you know, and they have Wi-Fi managed services for you to be able to manage those, how that Wi-Fi service is being used. So, you know, you touched a lot on some of the things for residents, you know, for property management and the ownership groups. You know, there's really a way now for them to control every aspect of service that they're providing. So if they're providing internet to their common areas, you know, a fitness room, a community room, if you have one person illegally downloading movies or doing something that they're not supposed to, you know, with managed Wi-Fi managed services, you have the ability to be able to, you know, monitor that, make sure that those things aren't happening.
Right.
You'd also have a way to monitor your data usage in general as well too, which is really important if you're getting X amount of speed from a provider, and you don't want, you know, one area using it all. It's a great way to be able to kind of siphon off your internet.
Well, I hadn't thought about that. The guy who's in your common area mining Bitcoin probably isn't healthy
Exactly.
for your system.
Yeah.
Yep.
Okay.
Yep.
Yeah.
All right, so we talked about entry technology. Oh, I'm sorry, the question. Yes, thank you for reminding me.
The first one was for the panel where they plug in, are those USB ports or plugging in? The second one is how are these paid for on a retrofit? Is that paid for all up front or is that charged over time?
Do you want to repeat the question for the online people?
His question was, as far as in the amenity spaces, that local connection, what type of connection was it? And then you were asking, how is it paid for retro?
Yeah, if you pay up front or if it's a combination of paid over time for one or
For the local for that connection?
for retrofitting the building.
For the landlord?
Oh.
Is that what you're asking? So the landlord has
The
to,
install and all of that?
Yeah.
Okay, well, the first answer, the local connection is honestly, it's usually just a wall mounted or a wall jack for an HDMI plug. They'll bring in their laptop or whatever, their own device and plug it in. And then it can display on any of the TVs in the area. And as far as payment wise, it's usually just a one-time install fee for it. And then it's done and upfront and you're over and you own it.
And depending on that system, I mean, you really can customize those to the needs that you would maybe want. You know, USB you could plug in there.
Yeah.
I certainly don't think the AV hookups, you know, the red, yellow, whites
No,
aren't a part of it anymore.
We're
but
not
the
hooking up the
HDMI
Ataris or anything.
Yeah, but it's certainly, those kind of services are customizable. Yeah.
Yep.
but that evolves, right? So it evolved from USB A to USB B to now USB C. And all of those inputs are, I think, you know, every time Apple changes their mind, there's a new type of input for
Well,
things.
And the wiring, so this wall plate, let's just use it as an example. That wall plate, it may be an HDMI connection at the plate, but it's not, behind that plate in the wall, it's not an HDMI cable run through. It's running on a category 6 cable, Cat 6. So that, with that cable, as technology changes, we need a different connection here or there. It's not rewiring everything, it's changing it at the plate to a different type of adapter that'll run over Cat 6.
Right, and the key here then is getting the fiber in the building. So that brought up an interesting question though. And so a lot of it's driven by Wi-Fi. You you know, in my house, I have 2. In an apartment building, how many locations and how many different access points for Wi-Fi do you end up needing to have?
Well, I mean, traditionally, you can run most units off of one Wi-Fi signal when it comes to an apartment. Kind of, you have more than enough power running through. There really is obviously your Wi-Fi router dependent. You know, how powerful that speed's going to be. But realistic, I mean, you talk about how many connected devices. I think I could probably count 15 alone in my home. You know, as you connect more devices, obviously there goes the degradation in speed, but you're certainly, that's, you know, that's part of the benefits of fiber, is having that symmetrical connection versus your more traditional offerings where, you know, a major provider may say, hey, I'm going to still run all my TV and services off coaxial, but I'm going to run fiber to the building. It still allows them to offer some faster speeds. It's just really not going to get, you're not getting that full benefit unless there's fiber to the unit. So in my experience, to answer your question, long-winded, is yeah, one Wi-Fi router should power enough. You know, it really just depends on the.
I was gonna say, for your typical unit, yeah, they will have a media panel in a closet or.
So
wherever.
one Wi-Fi router per apartment unit is
Yeah.
sort of what you're doing.
Yep.
And then how many in the amenity areas? Is that
That is dependent on.
how big it is and how many people?
Large it is. Usually we do what's called a heat map. So it'll
Okay.
show you where the access points should be placed. You know, we'll end up with one in the club room, one in the lobby, one in the fitness center, just so it kind of travels throughout.
So what I'm building up to is we'll do a little role playing. I'll be the building owner, and the first one that I'm going to come to you and say, this is a brownstone built in the 1930s, and I just got air conditioning in last week. What are you talking about, and what do I need to do to stay competitive?
Yeah, I mean, I think when you look at a lot of the different building types, just like the technology has evolved in the Wi-Fi space, the technology has evolved similarly in the wiring space as well too. So obviously in a new construction project, it's very simple, right? All of that work is being done as it's built. Retroactively, when you're doing it, it really depends on the building style, but being able to find different routes or similar routes that are being used. They also have designed in-unit mold wiring that you're able to kind of hide better into the units. So it really just depends on the building type. What we find with most buildings is, regardless if they're existing buildings are a large part of our portfolio. It's really just about finding what's that route, what's the best way we can hide the cable, because obviously, as everyone's aware in this room, is the aesthetics are just important. And, you know, traditionally in our space, there's been looping wires and, you know, unfortunately subcontractors that have done a really messy job. So when we get that question, it's really more of a question about assessment and what's the best solution for you. You know, that solution may be coming up from an underground garage. That solution may be utilizing some sort of molding in unit. It may mean, hey, we might have to come from the outside, but it really just depends on the property and what's the best way that we can keep the aesthetics clean.
Well, when COVID hit and we had to start producing stuff at my house, and a lot of we needed up speed, right? As well as down speed. That was a shock. I didn't know that those were two different things. And all of a sudden, you know, Zoom is glitching. But when I walked through the house with the drill bit this long and this big around, said, honey, I'm putting holes in the floor because we got to wire in direct now to get the bandwidth. I had, you know, I'm sure she would have liked to have known about the molding.
Yeah.
That was a possibility. So you guys aren't running around the property with the gigantic drill bit saying we're throwing holes everywhere. It's just something you can do discreetly.
Absolutely.
Yep.
And that's, I mean, it really honestly is just dependent upon the companies that do it. There's obviously a lot of different providers in the space. And I just would say, you know, exercise research and caution on those as well too, because, I think the unfortunate reality in the industry is, especially on the existing buildings, is let's just do it to make it work. And it's been less about aesthetics, and it's not been a real hands-on approach, which I think, like I said, at the end of the day comes to a detriment of the ownership group, making the property look ugly. And eventually that wires, something's going to happen to it where it's going to interact with their residents and, create upset.
But bring me back around to my discussion now, or role playing, if I'm that landlord with the brownstone. And I know we touched on a lot of this, but I want to bring it home for me so that I get my head around it. What are the things, once I get that, I went the fiber route. What are the technologies that I can say, okay, property manager, you've got this, this, and this, go. What are those top selling points?
For older buildings, top selling points right now, especially in this environment that we're in right now, access control and cameras are a huge deal. They want to be able to monitor who's coming and going. With the access control, management gets an audit trail of who's been in and out of every place. And they want to be able to utilize camera systems to actually see if there is an incident, just as a added selling factor to residents of, yes, we have security, yes, we have cameras, we're monitoring.
That's what I was going to ask. Is it the tenant saying I need security, or is the landlord saying I want to make sure my building's secure?
It's usually initiated by landlord or property manager. Like, we've had incidents, we need cameras, that type of stuff.
Yeah.
Yeah, I think especially for the existing, there was a study done that said about 85% of residents or tenants that are about to move in look to see what the property was offering in terms of technology. So again, really easy question to answer with new construction, because you're going to generally have the latest and greatest. When we talk about this these existing buildings, it's really about how can I take my Class C property and fancy it up into a B and make it more appealing? Because I think today's consumer is certainly going to be a lot more aware of, what kind of technology offers that you have within your building.
Do you see leasing agents ask for the ability to do kind of keyless entry or remote showings or self-showing? Somebody wanting to be able to just, I don't have to meet you at the property. You can just go in, I'll give you an access code.
Definitely. Yeah, that's becoming more and more. And that's what that turnkey solution, so to speak, for getting through with your butterfly and your access control and all that into a smart unit. The leasing agent can say, okay, unit 204 is going to be a showing. They'll send the potential resident, granting them access. They can get into the building, they can do what they need to do, they can get into the unit will automatically set up to, if it's a model unit, they can have it set up to lights come on to this percentage, music plays, whatever you want to do in it to show it. But then, that
I don't think we're playing music at my brownstone when somebody enters,
You
but
don't
I
want
bet
to?
if I built a nice Class A with a
Right.
$20,000 penthouse they were talking about earlier,
that one.
that person, when they show up, I probably want to be able to.
Yeah, but then that, that walkthrough again is scheduled. They're gonna walk through at 3 o'clock. Their access is only good for an hour or 2 hours, whatever, and then it's done.
Valuable too, especially with COVID. I think COVID has probably taught most property management companies that you don't necessarily need an on-site leasing person. They're at the property. A lot of this stuff can be done remotely. Especially, they've had this for a while, but the ability to pay rent on your phone, there's no more dropping a check off at the office and, having a good old conversation. It's, pay and it's on with my day.
It's all going through, like, there's different software to do that. There's resident portal where they can pay their rent, they can reserve the club room, they can, submit a maintenance ticket and all of it.
So maintenance is interesting. I met a gentleman in Austin, Texas, who's an apartment developer there, very driven, younger guy, just on a mission to acquire units and renovate and do better things. But he said, and it struck with me ever since, he said, I want to know when a light bulb's going to go out before it goes out. I want to know when a toilet's going to break. And he said that was the connected technology. What in the world is he talking about? You don't know either. Yeah,
No.
I think it's brilliant, but if you can figure it
It
out.
would be great.
But that's the next level of management, right?
Yeah.
Is if you've got Wi-Fi connected lighting, and a light bulb burns out,
You'll be aware.
you'll be aware.
Just think about, I mean, the way technology's run already. Look at Ring doorbell, right?
Mhm.
It starts off as a pitch on Shark Tank. Everybody's got a doorbell. How can you make this better? And just little things, I think it teaches you about technology is how can we make our lives easier? How do we stay more connected? And something as little as that, I mean, I remember watching that episode, like all four sharks passed on it, right? And, it turned out to be $1 billion idea. So it's, to me, if there's a will, there's a way. I mean, I'm sure if they figure out how to tell me that my light's gonna go out, somebody will figure it out sooner or later.
I'm glad you guys are around because I would be miserable at Shark Tank. I would pass on all of it. You all are nuts. There's no way. And then, billionaires are
Right.
made every day through technology. Well, let's talk about project size. So I'm back to my brownstone and it's an 8-unit and I'm a smaller landlord. And is there a price point that it makes sense at? Do I have to be a big landlord?
I think at least in terms of getting fiber to a property, I mean, fiber's been around a long time. I think the toughest part with it is the cost of construction, the underground boring to get it to the property. And that still remains to be a challenge. That's why companies like REJ has only worked in the multifamily route, right? It's a way for us to be able to justify a very large spend in that space. The way I've always told most clients is, there's an algorithm of how big your property is versus proximity to fiber. And as we continue to build out that space and other people build out the space, I think that number you're able to get to the lower units, but I think realistically in most cases, you need at least 50 units or so for really a company like REJ to come in and justify that large of a spend for them to be able to take on that cost for you. That's kind of one of the benefits. It's a blessing and the curse, right? The company will take on the cost of bringing that infrastructure to you. However, it's got to be in a way that's, it's low risk for us, or we can mitigate some of the risk.
Yeah, that goes back to the gentleman over here's question of who's footing the bill and how much is it? So you're saying there's a sharing in the case of where there's not fiber already to the property?
Yeah, so when there's fiber not, in most cases, when it's not to the property, I mean, some companies will obviously you could work an agreement where you could, if you want to invest in that, you certainly could. But most companies are going to do it based upon, are they going to be able to make the appropriate amount of revenue to be able to justify all of the extra work that goes into it? Because when you bring fiber to a property, right, that's the one part of the project. The other part of the project is, right, how do we get this into each unit? And especially retroactively when it's an existing building, you're looking at putting some cost into that as well too. So there are some challenges. There are clients that we have worked with that have been willing to invest in, my suggestion or my advice would be to say, be patient, and sooner or later fiber will be able to get to you. I mean, you look at our company alone, we have about 14,000 miles of fiber throughout the state. And there's, a couple other large providers as well too. So there's a large area that we're able to get to. It's more just about justifying the area. If we can build out a certain area, it makes it a lot easier to then start adding the units and the 4 units and the 2 units.
Well, and it would depend on, like you were saying, the offset. So if you're doing a bulk internet situation to a unit, to a building, so then REJ selling it to you at a bulk rate, and then you're reselling it to your residents. So then there's a little profit coming back to you to help offset the build out initial.
Now you're speaking finance people's language. All the finance people in the room just perked up and said, wait,
Say, I heard profit. And
you're right. Well, and that's how we can go back to landlords, developers, investors and say, here's where some things make sense.
Yeah.
And we can help you bridge that gap. So
Well, I think that's a real big one too right now, is just the bulk offering.
Yep.
Because again, it's all about, at the end of the day, it's about getting people into their building, getting about these leased up. And when you offer bulk service into it, I think, there obviously is ways for them to make a profit on it. But I think at the end of the day, really, it's about, they're going to make that profit off that resident moving in. And that's really, I think, what
It's a convenience thing
Yeah.
too, because now the resident isn't dealing with CenturyLink or whoever the provider is. They're not dealing with it when they move in. When they move in, the internet's there. It's already set up. It's just part of their rent.
Yeah, the old phone lines getting hooked up. Okay, go ahead. Oh, the question was, does running fiber qualify for PACE? I'm not sure.
that I unfortunately do not know.
There you go. Jay's good at helping you find connections.
Perfect.
That would be interesting to find out because PACE would be a great tool for that. That would be fun. We could bring some other panels back up. Okay, well, Jake, I'm glad you brought up challenges because we didn't talk much about that, but you mentioned the challenge of getting, not having the built up network of fiber in Minneapolis as maybe they do in some other connected cities. Or especially when you get out in the suburbs, or I think your company started up in God's green country,
Yep.
or white country in the wintertime.
Right.
What are some of the other challenges you all face? What are the biggest challenges in your business right now?
Well, the time, honestly, right now, the brownstones that are out there that want to upgrade and everything, those usually take up a lot more time to get everything going just because of the retrofits, and you're walking into a minefield, getting everything actually installed and going and upgraded.
Well, you didn't say labor though. I thought what
Labor.
would come out of your mouth, the very
Well,
next was, I might be able to find time, but I can't find people.
If we had more people, we'd have more time.
There you go.
Yeah, that is a big problem right now is labor in general. We can't find people to fill the need. I can find guys to pull wire, but real qualified technicians and employees are hard to come by right now.
Yeah, I would echo the same. I mean, I was talking to our construction group and, they have over 180 different projects that they're doing just along with our business team. That's separate from our multifamily projects that we're running into as well too. So a lot of the stuff that we're running into right now, most of it's COVID driven. They're small or short-term problems, things like permitting, working with some of the cities. Supply ordering, had been a bit of a challenge. Previously, that has really kind of gone away now, but really it's waiting on these cities. Because again, it's, we can get people in the ground and doing the construction part, but I think these cities are still struggling with trying to get through everything after this COVID year. So.
Yeah, it's hard to work from home and get everything done too.
Right.
So everything gets pushed back. Well, we got a couple minutes and we'll open up for questions, but I want to do a personal question. And that is, what is the, I'm going to say coolest piece of technology, but what is the most wondrous thing you've seen as you're doing this in your work? You might have blown it at come into your rental unit with music playing and the shades drawn. That's pretty
just
fantastic.
it on that type of stuff. It's how everything is going more and more cloud-based. So it gives the installation and setup has gone down astronomically, and the ease of use and the convenience for the user, where because it's all cloud-based, you're not tied to your unit. You can be anywhere in the world with internet and control whatever you want. So it's take all the technology going that direction is really helping everything.
Yeah, I think for me, it's more about, I'm more interested in the learning of this new tech. I think when it comes, there's not one piece of technology out there. Like I said, I could mention the fantasy football scenario
Right.
and different things like that. But for me, it's just watching companies redefine the way that we utilize technology to, fix X solution here, Y solution here. I think if you just watch history and in general through it, is watching systems go from key fobs to
Right.
keyless to phones. And really the possibilities are endless. You know, the reality of our world, feeling the need to stay connected, and God bless those millennials, but you know, I think you're only going to see more and more technology that keeps, you know, people interconnected. So
Well, and
interesting to see. That's for
what
sure.
you just said on the finding the solution, that's my favorite part of what we do, is sitting down with the developer or whatever. They just come to us with a wish list, and now we have to design and build and figure out what technology is going to fit the needs the best.
Yeah.
So
The wish list will be fun to watch that grow. I'm thinking if I own the brownstone and I have no parking, right? There's going to be a day when my connected technology is going to call me a driverless car. I don't want to have to offer parking with my apartment units anymore. That'll change things, won't it?
Well, I think there are some unique things too, I guess, to kind of echo off of that. You know, a lot of times when you were bringing fiber into a property, there are different things that we do, that we provide, like private fiber networks. And really, these are just unlit networks ready for somebody to use with technology. So it's the kind of systems that InFocus will use. And, you know, Arvig's not the only one that's doing this, but it's certainly something that we provide. But the beauty of it is when you're getting this infrastructure built into your building, there are ways for you to be able to kind of future-proof yourself, if you will, creating your network. So as new technology comes along, you're not paying another company to come in and bore new wires and figure out new wires. Really what you're doing from that point is just connecting in software and hardware solutions that kind of help fit the technology needs of your building, whether it's 5 years from now, 10 years from now, 20 years from now. You know, that fiber is not going to change. It's still going to be able to be utilized. Right.
So that brings me to, when somebody first described 5G to me, I think they had no idea what they were talking about, for the record, because after that point, had no idea what I was talking about. But I was struck by this is going to change everything. And now that I believe I have a better understanding of 5G, just tell me how it fits in with what you all are doing with the connected buildings. How does that puzzle?
Yeah,
you?
I mean, yeah, I think it really is going to be another offering. I mean, there are already 5G, the ability to offer those, it's really speed-based, technology-based. You know, that's why the infrastructure of that service it's running off fiber to be able to maximize those speeds. I think 5G it would kind of be another offshoot of what you can utilize with 5G or with fiber in multifamily. So it's going to be more about the technology that you'll be able to use with it, versus it being, you know, something that's going to compete with fiber necessarily. Right. You know, because that's really where I see when it comes to the 5G technology. It's about interconnection. It's about being able to offer service to very confined spaces. So going to be great in a downtown area. I was just in Boston over the weekend, and I had 5G all throughout their city, which was fantastic, right? Boston's this very congested area, and that's where I see a huge benefit to 5G. When it comes to multifamily, I think it's just going to be more technology that you'll be able to add on top of the infrastructure you'll already have in your building.
But the necessity for the fiber piece doesn't go away. That's my understanding now too. I think I got it wrong.
Yeah. So, I mean, we get that a lot where, you know, somebody will ask me like, Jake, I'm kind of waiting to see what 5G does. And really what my response to them is what you're doing is you're building the infrastructure in for 5G already into your building. So it's less work that's being done once that technology gets here.
right,
But
you're still utilizing the fiber that will be in there.
exactly.
It's just what you're piping down through the fiber.
Well, we got a few minutes before we're done. Does anybody in the audience have any questions, any dreamers about technology, or anybody practically speaking, any finance related, anything?
I tried to stay away from acronyms. So
You did much better than the last panel. You know what, next time I gotta threaten them to take that mirror down because that's a mirror behind.
Oh,
And for those of you that don't know, if you're losing your hair, like some of
yeah.
us, the Zoom camera, it shows up perfectly. So everybody in the Zoom world gets to highlight it. So that's my threat. If you like, don't answer the questions right, I'm gonna pull that down. Go ahead.
Until we can access all our buildings with facial recognition. You
Ooh.
can walk through, the doors open for you all the way to your unit. We can do that now.
Technology's there for it now. Yep.
Realistically,
It's still a premium right now. It's pretty pretty costly to do it right, but yeah, the technology's there. We have not a multifamily, but a commercial client who has that for employees getting in and out of the building and navigating through certain areas. So.
How much of the back end is just data collected, knowing who's in, who's out all the time? Is that assumed into the process?
Yep.
If it's facial recognition, we're also reporting everybody.
Yep, you're essentially who's coming and going. You have a full audit trail of who's been where.
But you're already doing that. You were doing that in the fob days,
With the
right?
fob system, now, yeah, with the fob system, you still have an audit trail of who's, Todd's fob is going through all these doors. But you're still going on the honor system that it's you
Yes.
using it.
That's a
With
good
the
point.
facial recognition, I know it's you coming through there because without your face, you're not getting through there.
I'm kind of thinking Mission Impossible, aren't you?
Big brother.
Peel your skin off and you're somebody totally different.
Right?
And it's Tom Cruise. Speaking of which, I'm horrified that Top Gun 2 got pushed back another like 6 months. What are we doing?
right?
It's so sad.
Now I have to update my calendar.
May 29th, I think I lost. I know, right? Maybe I'm the only person in the room that's all fired up.
No, I've been waiting years for it.
I'm your wingman any day. All right. Anything else? Any other questions, or we will wrap it up? Everybody's saying, I know these 4 hours are long and I understand. And thank you all for sitting around and paying attention for a full day. And thank you for allowing us to do a technology piece mixed in with some financing piece. I hope everybody found it very useful, both online. Looks like a lot of people stuck around online. So appreciate both of your time and look forward to the next steps of technology. Let's give them a round of applause. Do not forget, if you're here for CE, you need to sign in and sign out. If you're online for CE, we like it if you go in the chat room and enter your name and your number, your license number, because if we ever get audited, all of that stuff goes in there and gets timestamped. So that's helpful for the online people. So name and license number. If you didn't answer the questions, we can't offer you credit, and don't forget to sign out. And thank you. Have a wonderful Friday.